estimate?
It's hard to say, Tom, because it's very surprising that their provision for loan losses is considerably higher than expectations in view of what we saw yesterday, but also in view of the improvement in the economy. And with the new accounting for loan loss reserve building, which takes the loan loss provision into account, the banks have to do a life of loan analysis, and that takes into account the state of the economy. And the economy has improved from the second quarter, which is why we saw such improvement yesterday. But here at Bank of America,
Gerard, I've got to interrupt. We have a correction from Bloomberg. And I want to make clear, this is the second day in a row. Francine and I are not happy about this. We're going to stop the show right now because this is an important correction. Bank of America provision for credit losses was not $5 billion. It was $1.39 billion. Gerard, I'm going to start with you and then go to Allison. This is much more like J.P. Morgan, Gerard, where instead of $1.9 billion, we have $1.4 billion in credit losses, and it is J.P. Morgan-like, correct?
That's correct, Tom, and my heart's back in my chest. Thank you. That's much more in line with, better than expectations, of course, as you pointed out, but more in line with the other two. It was rather shocking that it would have been $5 billion, but obviously it was an error. But this is another good sign. But once again, as I was saying, since the second quarter, these banks have to make these assumptions about the future of the economy, and as you and I both know, it's improved.
Okay, Allison Williams, with this massive credit mistake by Bloomberg, I really want to be sure here, folks, we've got it. We reported a $5 billion in credit losses, and the number is dramatically better for Mr. Moynihan and the team and doing better. Allison Williams, we're seeing better credit losses from Bank of America, J.P. Morgan, and the rest. Is that because the credit losses are to come in Q4, or have they dodged the proverbial pandemic bullet?
So I think what we're seeing this quarter, so as I said, and we'll see if it's the case with Bank of America. The 5.1, by the way, is the last quarter number. The expectation was 1.9, and the actual is 1.4.
Yeah.
And so it was lower than expected. And what we're seeing across the banks is it's the balances are coming down. So the reserve ratios are steady, which means that they're not really changing their view on credit. And keep in mind, the accounting for these banks is that in the first half, we had this accounting change, and basically what the banks are required to do is to look out over the life of these loans and say what they expect over the life. So it's not about this quarter or next quarter. So the charge-offs really have not started to come through. J.P. Morgan and Citigroup both said they expect things to really significantly increase in the second half of next year. A lot of that really relates to just the flow-through of credit card, just sort of the accounting on the way the delinquencies work and the fact that we have a lot of fiscal support, the government support and the programs right now. So it's really just a matter of math and timing that those charge-offs are not going to come through. But the provisions we saw in the first half really were sort of looking towards that.
I mean, the real question is, why can they just not simplify what they put out there in terms of earnings? I mean, who gets it right? Why is this so complicated to understand whether they beat or didn't beat?
Well, I think it is because the accounting is so forward-looking. This is a new rule, and it's basically made to, as I said, day one, set aside what you think over the life. But I think the impact that it has, the impact that we saw in the first half, really, right, is something that we call a little bit pro-cyclical. So when things start to worsen, the provisions are so much bigger, and then when things start to improve, it'll go the other way. And so to some extent, the banks sort of preparing their balance sheets for the pain to come. But I think beyond that, we're going to, as I said, we're going to want to look to see what's happening with the loan portfolio. Commercial balances, we know, we're shrinking across the industry. Card balances have been declining. That's probably some of the reason for the reserve. That's also the reason why we're getting the net interest income hit, and we're seeing sort of that pain to come. Trading, which has been a great story, is not necessarily repeatable. And so I think that was the worry yesterday, is that the big surprises we're getting are better trading, better capital markets, these reserve releases, neither of which are sustainable necessarily.
Allison Williams and Gerard Cassidy, both of you, just world-class performers. We thank you for the tumult of the last 15 minutes over those changes. Mr. Cassidy with RBC Capital Markets and Allison Williams holding court at Bloomberg Intelligence as well. To be clear here, we corrected on the credit losses as best we could. Better numbers for Bank of America than we published 15 minutes ago. On Bloomberg Markets today, Francine Lacroix and Kristalina Georgieva. This is Bloomberg. Good morning.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
The second half will be a lot stronger than the first half in China. We're heading to what we call the golden season of auto sales.
We are very confident, we're going to have another big growth, 2021 versus 2020.
We did not see people kind of holding back.
Chinese customers are into, right now, buying individual mobility.
Failure of both monetary and fiscal policy is that the money isn't getting to the right people.
I think we're going to be stunned by the degree of earnings upgrades.
Monetary policy looks like it's pretty much on hold for a long period of time.
The numbers this year don't really tell us as much as we need to know about the future.
We've never had these kinds of numbers before. We've never had these trajectories.
It all comes back to the Fed. The Fed is very concerned about the outlook, whether it's L-shape or U-shape.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance, live on Bloomberg TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures this Wednesday morning, down 7. We're negative 0.2% on the S&P 500. Tom Keene, 20 days to go.
20 days to go, really heating up as well. Mike Allen just published this moments ago at Axios talking about the scrutiny of Mr. Biden. As you know, John, he's been extremely quiet. And you've really got to believe with the tone that we got from the president last night, I thought more invigorated than in the recent days, that this is really going to heat up into the kind of campaign many people have been expecting, as you say, with 20 days to go.
You have to say, Tom, heating up on Capitol Hill as well. House Speaker Nancy Pelosi under a little bit of pressure. A $2 trillion game of chicken playing out down in Washington, D.C. The back and forth starting to build again.
Yeah, I mean, she's going after Wolf Blitzer of CNN, which is, that's like un-American to do that. But, seriously, John, it's heating up as well. And, in talking to Tim Adams yesterday from Kentucky, as we did, Mr. Adams made clear on air that Mr. McConnell is comfortable there. John, the wow tweet so far, the campaign, is the Cook Political Report, hugely respected, came out about 4 o'clock yesterday afternoon and went to a 7-seat gain for the Democrats in the Senate. That's unframeable weeks ago. That the momentum and the change is now extraordinary.
The shift has been phenomenal. We'll catch up with Kevin Cirilli in about 10 minutes' time. We've got to talk about the bank numbers as well this morning. Bank of America coming out with numbers, provisions lighter than expected, EPS firmer than expected. Lisa, next couple of hours, more banks still to come.
Yeah, Goldman Sachs in particular and Wells Fargo. Goldman Sachs in about a half an hour time. I'm very interested to hear what their debt trading revenues look like. Bank of America underwhelming a touch on that front, with JP Morgan and Citigroup both overwhelming on that front. So there's sort of a game here for market share. Also, today is another day of fire hose of Fed speak. We're getting Clarida, Barkin, Quarles, and Kaplan. I'm particularly interested in Randy Quarles, the vice chair of supervision, talking about financial stability with asset prices as high as they are. And John, to your point about what we might get on the fiscal talk side, U.S. Treasury Secretary Steve Mnuchin speaking at 11:30 today at the Milken Institute conference. Interesting to see whether the Republican leadership is getting on board with President Trump and his proposal. At this point, it seems like that fissure is getting more entrenched.
The president tweeting, Lisa, stimulus go big or go home. We understand that Secretary Mnuchin won't be going home. He'll be going to the Middle East next week, Tom. So if you're hoping for some big talks on Capitol Hill around the fiscal side of things, Secretary Mnuchin might not be around.
Well, he might not be around, but again, I go back to what you said, John, 20 days to go, and every election changes. You get into this stretch into late October, and of course, this is a unique election. We can all agree on that, but it's just simple, John. There's 20 days to go, and it's heating up. I mean, what are we going to see 24 hours from now after another day of campaign?
Couldn't tell you. 3 weeks away. Feels like a lifetime still. Let's get to the equity price action this morning. Whip through things cross-asset worldwide. Equities just started to turn lower in the last hour on the S&P 500. We're -6, no drama, down a little more than 0.1%. NASDAQ futures just about positive on the session. In the bond market, down a basis point or two on a 10-year in the United States to 0.71%. In Italy, record low yields again, 64 basis points, Tom, on a 10-year in Italy. The compression across the continent has been remarkable over the last couple of weeks.
You see that with that real yield. Of course, we're looking for the real yield later this weekend, a property of John Ferro. And John, there it is at a 0.99. I just had it on the screen. My eyes are failing me. There it is, 0.9945, a negative statistic. That's a recent low for that real yield. And again, one of the indicators there of the disinflationary tendencies out there.
A Wednesday promo for real yield. I'll take it, Tom. Thank you, sir. Dan Alpert joining us now, Westwood Capital Managing Partner. Dan, I got your notes this morning, and the first line just jumped out big time. Equities are trading on non-economic news, speculation, and the absence of any other place to put money and potentially earn positive real returns. Dan, is that all it is?
Well, equity markets rise to extraordinarily high multiples on one of two reasons. One is high volume during high growth in the economy, and the other is on low volume and relatively low or stagnant growth in the economy due to the absence of the ability to make money in anything other than the fantasies that equities enable. So I'll leave you to figure out which one this is, but I don't think it's high volume and high growth.
Dan Alpert, what is the view on the American labor economy? I believe elections are about jobs. We learned that in school, didn't we? You and Cornell Law are doing path-breaking research on this. What's the latest you have on the labor economy so we can brief the politicians all on this?
Well, the most salient statistic right now is the continued high levels of unemployment insurance claims. They come out every week. They've been ranging between 800 and 900,000. And this is not stopping. And the reason is that we're getting a regurgitation of people who were previously reemployed back into the pool of people who've been laid off. And this continues as both small and medium-sized enterprises begin to determine whether or not they can make it for the long haul, those that were propped up by PPP and other programs. And then finally, you're now seeing, obviously, the very, very substantial layoffs by large businesses, corporations, airlines, et cetera, that have delayed that pattern, and that's contributing to the problem. So, the notion that this is sort of occurring in a vacuum, that the unemployment claims data is occurring in some sort of vacuum while the jobs picture improves in other data is insane. We can't continue to live in this bipolar world where we see these enormous claims on the one hand, and then on the other hand, you start having these very precise discussions over what was the test date for the BLS data in a given particular month, and whether that actually reflects the state of the economy on the date that the jobs numbers come out.
So, Dan, I'm sympathetic to the sort of bearish view that you have. I'm sure that John is smiling right now as he hears me say that. At the same time, looking at some of these bank earnings, they're setting aside less to cover loan loss provisions, to cover loan losses, and they're even having lower charge-offs than they had previously expected. A lot of the data is still coming out better than people had hoped. Why are you right, and that markets are not accounting for distress currently in the economy? And why are you right and markets wrong?
I'm very glad that you asked that question. I mean, I was watching a few minutes ago where there was that little glitch in the Bank of America loan loss provisions data. I started rewriting everything I was going to say, but what I'm going to say now basically is what I was going to write, what I was going to say before that, which is that, as a practical matter, we have a huge amount of irremediable financial obligations in what is effectively a very, very slow-moving train wreck in terms of financial obligations. You have household rents in multifamily that are deferred because of moratoria, but they haven't been eliminated, and there's a very, very high prospect of default in that category. You have commercial rents, retail, and office that will ultimately not be paid. And, the question is, what is that going to do to the lenders that have been so far forbearing? You have things like the hotel sector, which is just going to be absolutely catastrophic when it attempts to reopen. There's no way that the back interest is going to be payable on most of those loans. There's going to be substantial write-downs. You may have some degree of household mortgage defaults that come out. Not everyone is on the upward end of that K-shaped recovery. Some people are on the downward end and have lost their jobs. You have consumer credit. Then you have, obviously, business debt, conventional C&I debt, especially in smaller banks, that you're going to have SMEs that just cannot survive. And so, you don't see it right now, and I think the banks are being overly optimistic and under-provisioning. And, the fact is that at the end of the day, all of that is driven by employment and aggregate demand.
Dan Alpert, great to catch up with you, sir. Let's get your thoughts on the program. Dan Alpert there of Westwood Capital, and Lisa Bravitz, very much on brand, as always, on Bloomberg Surveillance.
Hey, just
smile, Lisa.
Hold on a second. For the record, I actually had an argument that was bullish, basically saying the numbers are coming in better than expected. I just want to put that out there on the record, John.
Can we clip that moment, Tom Keene? Can we put that in a highlight reel?
Yeah.
I'm in shock.
I'm in shock.
I'm in shock. Was Lisa slightly constructive?
No, you have to look at reality. And this is sort of the challenge right now, is our reality that we're looking at, lower loan losses and lower charge-offs. Yeah. Is that just a result of the leftover money, or is that the result of a better than expected economy? It's a big question. People don't really have a good sense of that.
That was the Lisa Abramowitz correction, Tom Keene, in the last 30 seconds, I think.
I mean, what a day it's been. It's Wednesday, or we've got claims coming up tomorrow with the kind of gloomy numbers that Mr. Alpert's talking about. And John, you look at the markets as well. The NASDAQ now back slightly green after more green 2 hours ago. The jumble here is stark, but to be honest, John, also expected. Again, I go back to your top of the show comment. We're 20 days to the election, and it's picked up with a vengeance here. I mean, just this morning, the New York Post, clearly in support of President Trump, out with a lengthy dissertation on the vice president's son, Hunter Biden, on Ukraine. It's sourced out of Mr. Giuliani, who I believe we talked to last week, and then it's sourced out of maybe Steve Bannon as well. Very political, very angled, but all of a sudden the heat is on, as it's been in elections since the beginning of time.
You remember that line from a couple of weeks ago, what a year last week was?
Yeah.
1 week feels like a lifetime ago. We've got 3 more of them still to come, Tom.
John, at 4 p.m. yesterday, I literally turned to Vet Bill and I said, it's Wednesday, right? I mean, I'd lost track of the days. It's been that crazy.
Tom Keene talking to his dog, and it's only Wednesday. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. Coming up on the programme, Liz Ann Saunders, Charles Schwab, Chief Investment Strategist. Looking forward to that conversation. Any words for the dog this morning, Tom? Just
it's
in
his
case
birthday.
Happy birthday.
Happy birthday.
It's Vet Bill's
there we go.
Birthday. It's 3.
This show is nuts.
It's 3. Just
equities down 2.
He wants to move out.
The S&P. With you, this is Bloomberg.
With the First Word News, I'm Kaylee Lyons. Prospects for another stimulus package before Election Day look bleak. President Donald Trump and Senate Republicans are at odds. The president is urging them to, quote, go big or go home. But Senate Majority Leader Mitch McConnell is only committing to vote on the Paycheck Protection Program for small businesses. Meanwhile, House Speaker Nancy Pelosi is demanding the White House revamp its latest offer. She says it's not big enough. Meanwhile, the world's top central banks are urging governments to keep spending. They say that concerns about mounting debt should be put aside until the economic recovery from the coronavirus is complete. The IMF is normally a champion of budget restraint, but the fund agrees that it is too early to end support. In the UK, there's growing pressure on Prime Minister Boris Johnson to order a circuit breaker lockdown. The opposition Labour Party and government scientists say it is needed to get the coronavirus under control. Deaths have soared to their highest level since June. Concerns are mounting that Johnson's new system of restrictions are not enough. Russia has ruled out a deal with the U.S. on nuclear weapons before the presidential election. The deputy foreign minister dismissed a call by Washington for a freeze on their arsenals as unacceptable. The last agreement limiting the nuclear weapons of the former Cold War opponents expires in February. And Bloomberg has learned that ConocoPhillips is in talks to buy rival Concho Resources. The company has a market value of about $8.7 billion. Conoco is looking to make a bet on shale in the midst of an historic downturn in the oil industry. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I'm not sure to the extent there's a suggestion that I have an agenda that I want to strike down people's protection for pre-existing conditions. That's just not true. I've never taken that position, and as I've also said repeatedly, any policy preferences that I have don't matter anyway. They're irrelevant. So making that law, coming out with the contours of the ACA, that's your job.
Amy Coney Barrett there, Supreme Court Justice nominee. The hearings continue on Capitol Hill. That's where the focus is for Senate Republicans. From London and New York this morning, good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 2 hours, 12 minutes away from the cash open this Wednesday morning. Here's the price action for you in the equity market. The S&P 500, dead flat. Futures going nowhere. Yeah. The FX market, the euro dollar, a little bit of a snooze as well, 117.41 on a euro. In the FX market, take a look at sterling. The Prime Minister and this government apparently backing away from that October 15th deadline. What do I think about Brexit? Do you really want to go there?
No, what do you think about sterling's move today?
It'll change all over again. I think one of the most important things happening in the UK is not this excuse for negotiations with the European Union. It's what happens with restrictions. So Keir Starmer, leader of the Labour Party, the opposition party here in the United Kingdom, pushing the Prime Minister and this government to bring in a 2 to 3 week circuit breaker, a national lockdown. The Prime Minister in the House of Commons in the last 10 minutes or so, Tom, saying that the tiered regional approach is the right way forward. But every morning you wake up here in the United Kingdom, you get the daily newspapers, the front page, the pressure building on the Prime Minister Boris Johnson.
You know, interesting, and of course we'll see where that heads in the coming literally hours, if not days as well. Right now, Kevin Cirilli, what we take great pride on at Bloomberg Surveillance is sort of taking the zeitgeist and parsing it out, and we are advantaged with our chief Washington correspondent who really reports on this in the trenches all day. Kevin, here's the lay of the land, changing by the moment, 20 days to the election. The New York Post, clearly pro-Trump, puts out a cover treatment on Hunter Biden, on Ukraine, sourcing out Mr. Giuliani, Mr. Costello, his attorney, maybe sourcing out Steve Bannon as well. It's a lengthy article about the vice president compromised by Ukraine. The indirect allusion is picked up by Mike Allen in Axios 20 minutes ago, who basically says, with Mr. Biden so reticent because of the campaign because of the pandemic to campaign, that Mr. Biden has really not had the scrupulous analysis of most candidates. Is that true?
Look, I'm going to cut to the chase here. I mean, here we are 20 days out from an election, and you know this, Tom. The audience knows this. I mean, you look at the Twitterazzi, you look at the pundits on both sides of the aisle, and what they are doing is auditioning to be a lobbyist of sorts or a consultant of sorts in an administration to arrange meetings. Those meetings cost a lot of money. The question from a geopolitical sense is who advises the commander-in-chief, right? We've seen this play out in the past 4 years. It obviously predates this White House. But the question that the Post is touching on is on foreign policy, who will have the commander-in-chief's ear? In this case, should it be President Biden as he's looking at rallying Western allies in Europe, as he's looking at the Nord Stream 2 pipeline, as he's looking at dealing with Russia, which he says he would be more combative with? Who would be arranging his meetings? That's the central question. Enough of the gossip, enough of the sideshows. That's the key question that if there is a debate, that President Trump and Joe Biden will contrast each other on.
And just to give you a window into surveillance, John Farrow's over in London right now, and he's looking at the football fixtures for the weekend and all that, and Lisa's worrying about how gloomy to get in the next 10 minutes. I'm looking at a wall screen over here in my studio, and it's non-Biden, 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 Biden, and then Fox, of course, Kevin, is 24/7 on Joe Biden and Ukraine and Hunter Biden. In that, does that kind of polarity work in this election, Or is this election so unusual with 20 days ago that the old formulas don't work? Back to Jefferson and Adams.
Well, I think you could argue that MSNBC did the same thing with Natalia Veselnitskaya a couple of years ago. But look, the bottom line here is twofold. This is the crunch time with 20 days out until the election, and the president is in need of some type of major trajectory shift between now and election day, and they're looking at every possible opportunity in order to do so.
Merseyside derby, if you're interested.
I know you are.
This Saturday in a lockdown Liverpool, and a lot of pressure
not real football,
on the broadcasters here to show the game for free. Oh, Kevin.
Amen.
That was Kevin Cirilli down in Washington, D.C. Kevin, we'll catch up with you tomorrow. I'm joking. Kevin, let's talk about the absence of the debates down tomorrow. The absence of debates tomorrow and what the candidates are doing.
Well said,
we understand NBC saying the president will hold a town hall style meeting, Thursday, 8 p.m. I understand Eastern time. The former Vice President Joe Biden will be on ABC. Kevin, walk me through those scenarios and how they can make it count.
Well, because President Trump doesn't, based upon the conversations that I have, they've made a decided decision. He doesn't need a debate. He's not trying to convince the suburbs. He's not trying to convince swing voters. I mean, they are really focusing on amplifying and running up the margins in red districts. That's their strategy. Whether it's a smart one, we'll find out in 20 days. But for Democrats, they feel they do good in debates. I mean, Biden had a very strong debate. He got a bump out of the polls. He extended his margins. And they are very much trying to get Republicans who are skeptical of going Democrat, but very apprehensive of giving the president 4 more years. They're trying to make a play for those votes and to run up the margins in the suburbs. They view that as an opportunity. So to be candid with you, the president doesn't see a second debate as helping him. A final debate, arguably one more, that would be something that they likely would be more likely to participate in based upon the conversations I'm having.
Kevin, just quickly here, I'm wondering if there's any chance that Republican leaders, Mitch McConnell, I'm thinking in particular, will get more on board with President Trump's hope for a bigger stimulus bill.
You know, I look, and I think you saw this in Speaker Pelosi's interview with Wolf Blitzer yesterday, in the sense of just the intensity around this. I think all sides are feeling this. I think that increasingly rank and file members in both parties are speaking more vocally about their frustration with leadership for not being able to get a deal. $1.8 trillion coming from the White House is a significant chunk of change. It's more than any of the 2008 money that was allocated in the last crisis. So the idea that that's not a lot of money is not making sense to a lot of centrist Democrats who might not have the committee chairs, but when I talk to them, they're palpably, I mean, you can feel their frustration that they're not able to get aid to their constituents.
Kevin, we might have you back tomorrow. It's great to catch up.
It's 50-50.
Kevin Cirilli, Bloomberg Chief Washington Correspondent.
50-50.
Kevin,
You're
thank
great.
you. More bank earnings to get to, guys. Goldman dropping across the Bloomberg. Here are the numbers. We'll get to the story in a moment. Upside surprise, fixed sales and trading revenue coming in at $2.5 billion. The estimate, 2.27. That's fixed sales and trading revenue. Trading revenue for the third quarter, $4.5 billion, just north of that number. The estimate about 4.4. Investment banking revenue in at just shy of $2 billion. The estimate, 175. EPS, 968. They're the numbers, Tom. Upside surprise across the board, it looks like, here this morning.
Yeah, no question about it. I really want to give them a shout out. The distribution of Goldman Sachs earnings is way better than some of the other banks that we've seen. These are very good numbers, John. I know we're going to have some experts parachute in here, but I see some nice upper double-digit growth in the tangible book area.
And a move higher in the stock, up by 1.9%. Coming up shortly, Shanali Basak to break down these numbers, and we'll catch up with Marty Mosby of Vining Sparks. We do that next, right here on Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York and London, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro, 2 hours away from the opening bell in New York this Wednesday morning. Here's your price action on the S&P 500. We turn a little bit lower, then we turn back again. We're unchanged on the S&P, and the FX market also unchanged at 117.43. In the bond market, yields come in about a basis point to 0.71%. Don't let this fool you. The price action of this week has been fascinating, particularly for the big tech stocks, but also because of bank earnings. We had more numbers from Goldman just moments ago. This is the commentary from the Goldman CEO. Clients are beginning to emerge from the pandemic economy. On the story of the release this morning, here's Bloomberg's Shonali Bassett. Good morning to you, Shonali. What do you see in the figures this morning?
The figures are pretty clean across the board, John. Fixed income coming in with a whopping 49% jump. That is much bigger than we saw from JP Morgan. But equities trading is a little bit light. There are going to be some questions about that. We saw them posting a return on equity that was through the roof, 17.5%. May I remind you that Goldman this year earlier had set out a goal to boost return on equity beyond 13% over the next 5 years. There were a lot of concerns about that when this pandemic started, but they are showing that they can take advantage of this tough time.
And the stock pops here. We'll get that up there, 2.6% for those of you on Bloomberg Radio. We welcome all of you. Shonali, the headcount that comes on, and I looked at expenses, and they still got headcount increased by 5% as well. The age-old question, Shonali, is this really a bank? I don't buy it. They're not giving out toasters at Christmas.
I wouldn't get too excited about the headcount, Tom. Those were campus hires, they had said. So we might see that headcount go down over the next couple of years, or Goldman at least moving some people to lower cost locations. We know some job cuts are already coming from Goldman. We know that they are trying to make their partner ranks much more exclusive. So the cost cutting story, yes, expenses increase, but they also want to stay competitive and compete. You have Goldman, you have JP Morgan bringing people back into the office at this time. They want to gain share.
You see the shade Shonali just threw me there? Like she basically said, Tom, you don't know what you're talking about?
Well,
she basically told you were wrong in a really diplomatic and polite way.
I will say, John, you picked up on a really important point here. The idea that Goldman's chief executive officer said that clients are beginning to emerge from the pandemic economy. Shonali, it seems like this is even rosier than what we have seen and heard from the other banks that have reported so far. Is that the case?
It is rosy. And, we have Morgan Stanley tomorrow. We heard from James Gorman last week. He felt rosy enough about the economy to make one of the biggest deals since the financial crisis, even when the Fed is trying to constrain some capital. Lisa, I know you love of debt underwriting, but equities underwriting also going through the roof here, and people are going to public markets again with at least optimism in the markets, if not the economy.
You didn't answer my question, Shanali. Is this thing a bank? I mean, I just don't buy it. I mean, I get they're doing trading, they're doing fixed income, they're doing equities, but can you actually compare Goldman Sachs to JP Morgan or Bank of America?
No, you certainly can't, but at the same time, their consumer business is clocking in more than $1 billion, $1.5 billion in revenue. So they are growing it. They are getting deposits. People want to go digital. But if anybody has a Marcus account, you know that that interest rate is falling constantly. So they are trying to appeal to consumers with this credit card. It's working. It's working on a much smaller scale than you see from the much bigger banks, and they have competition there to contend with too.
We're lucky to have a lot of students who listen and watch this program. And Tom, I think they've just learned that what defines whether you are a bank or not is whether you receive a toaster. Apparently that's it. And I'm so pleased that Shanali didn't answer the question. Shanali, the cheat guide yesterday was to wait for the earnings call. We're waiting for the earnings call for two banks this morning. What happened yesterday for JP Morgan, for Citi, the lessons learned, and what you're looking out for a little bit later this morning?
Listen, there are two things here, because you're right. At first it looks really rosy, but then people listen to the calls and realize they are going to be seeing pain from the banks through the end of next year, at least. And if that's the case, what are the banks going to hang their hat on when it comes to growth in different business lines? Even with Goldman and the consumer, there are troubles in the consumer. And so are they seeing the ability to rake in a lot of revenue from businesses that are not Wall Street businesses?
Very good. Shanali Basak, thank you so much. Right now, Martin Mosby joins us with Vining Sparks, Director of the Bank Advisory and Strategic Services. Marty, what's the Goldman Sachs strategy? What is the plan forward for the new Goldman Sachs?
So the new Goldman Sachs is basically to be a leaner machine on what you're calling the non-bank area or the brokered area. So they're trying to get more efficient, more effective. And what they're getting right now is a little bit of that effectiveness with a lot of transactions. While you're getting everybody issuing deals because rates are so low, stock market has rebounded, so valuations are high in certain industries. So they can go out and raise capital. So investment banking and capital markets at Goldman Sachs, at JP Morgan, at Morgan Stanley are all hitting, kind of record revenues. So you get that leverage on the non-bank side. Great revenues, focus on building efficiencies. On the banking side, what you have is, because they're going to be regulated as a bank, even though they really aren't a bank, they're still regulated as a bank. Well, why not take advantage of other businesses? And that's why they're building out that consumer bank. And right now, it's going to work out a lot better than even what they imagined, because consumer finance businesses, which is what they have a very high quality, high grade consumer finance business, but can get funding at very low levels, and the yields aren't as competitive. You don't push those yields down with interest rates as much. So the spread that they're getting off that balance sheet side is going to actually be wider in this lower for longer, rate environment. So it's a nice business to be in this environment, and they're getting the benefits that we talked about in the non-bank side.
Marty, this is a strange recession. A lot of people saying we don't really understand the true pain because of the amount of money pumped into the system on the fiscal and the monetary side, supporting the balance sheets of consumers. Jamie Dimon indicated some caution earlier this year. Are the results that we're seeing now with lower loan loss provisions, lower write-downs, does this indicate that the economy is in better shape and that these banks are poised to do very well in the upcoming quarters?
Actually, it doesn't reflect any of that. And this is what's so, I was fighting this, as we were going into it, is this new accounting called CECL creates this dynamic. If you look at credit costs, true credit costs, which is net charge-offs, absolutely flat to last year. We're not seeing any increase at all because of all the stimulus you've talked about. On the other hand, you've had headline economic news that's been so bad as we went through the downturn and the shutdown in the second quarter, that the accounting forced all this build of provision. So the earnings were getting hit artificially just on expectation and guesses of what was going to happen. It was models. It wasn't real losses. So now what we have is the third quarter economic activity gets better Well, the accounting then forces the provisions to fall very dramatically, which is why you have such a dispersion out there with, people trying to estimate what the provision's going to be. They haven't really locked in yet to this accounting. So all that to say this, there's been a lot of dislocation, a lot of disruption. The banks have built provisioning 3 times faster because of the accounting than what they did in the last recession. And now it's a wait and see. 2021 is when the actual losses actually will begin to be realized and recognized. It'll become clear as we move through next year, did they get ahead of it or do they still have some more to go? Either way, this isn't about survivability. They have enough capital. If banks can sustain their dividends, which they've been doing, if they can preserve their capital, which they're well positioned to be able to do, and if they can build the provision, which the accounting forced them to do, they will accomplish success through this recession. And the discounted valuations will eventually be proven wrong. It'll just take some time to get through that whole process.
Well, Marty, how dependent is that theory on what happens next in Washington?
Not really that much, other than, how is the economy going to react to if tax reform, happens, or what happens if regulation kicks back up again. So the economy is going to go through, and the dislocation that's happened and the recognition of those losses is well beyond, which administration is going to be in place. There's things that are just going to change behavior that are going to affect the businesses. And that's just already been built into, what we've experienced this year.
Marty, we got Wells Fargo at 8 o'clock. Let's drive forward to the train wreck. How are they doing in restructuring? How are they doing in erasing 10 years of challenges?
At this point, it's almost like there's 2 points on Wells Fargo. One is what they've done as a management team and been forced to do here this year disconnects Wells Fargo from anything that we've known before. So the legacy of being a high-performing bank, the legacy that we know of the kind of gold standard, you can just throw it out the window. What we have now is it's too early to look at Charlie Scharf and say, okay, what's the report card? It's like Brian Moynihan when he was first going through his process.
Yeah, well said, yeah.
And so what we have to do is this year is just a throwaway year with so many different things happening. They're recalibrating everything. And so what we're doing is we're kind of going to build from this base and move forward. And next year will be the year when, Wells Fargo has to prove itself. It has to start reversing the path. Instead of going down, it has to start building. And they've de-risked. They had a chance to do that. So there's probably a lot less in the sense of, overall losses as they move forward than what the rest of the group may look like.
Marty, great to catch up, sir. As always, Marty Mosby there at Varney Sparks on a bank earnings this morning. Bank of America and Goldman behind us. Goldman, session highs now, up a little more than 3% in early trading.
Yeah.
Tom Keene, 19 minutes away, Wells Fargo.
19 minutes away, Wells Fargo. I think Marty had some nice comments there on the challenges for it as well. John, I got to go back to the Merseyside Derby of Liverpool and Everton. I mean, this year it really matters, doesn't it? Because Sir Paul McCartney likes both teams. He mentioned that in GQ a couple weeks ago. Tell us about, out of nowhere, Everton gets better.
Carlo Ancelotti, former AC Milan player and coach, Tom Keene, took over the club.
I knew that, John. I was just getting you going here.
I know, just doing it for me. Built a great lineup. Got James Rodriguez over, the player he used to coach.
So this is like actually a real game.
Looking good.
It's like
absolutely. Plus, there is a really important cultural aspect to this. Liverpool's just gone through a lockdown. Tier 3, lockdown, Tom. Bigger restrictions coming from this government. And this Saturday morning, they'll see both sides of that city play each other in a much-anticipated derby. And the pressure has built, and I mentioned this earlier in the hour, for the local broadcaster here in the UK to make sure that the people in Liverpool can watch that game live on TV for free. And I hope they do that, Tom, because I think that'd be a nice gesture.
Well, it wouldn't be what you have in America now, or even the radio you got to pay for. John, I'm just fascinated by it. And, Lisa, his tone just changes when he starts talking about this stuff.
We didn't even talk about
you mentioned
King
AC
James
Milan
earlier. I mean, yes, I understand. But, there's a lot going on here in the U.S., too, Tom. Just saying.
Well, okay, there is.
I'm not saying
the Giants are 0-8. The Jets are 0-9. The Eagles are 1-9.
Fair enough. Let's go to London.
All
right, John,
let's
keep
go to
talking.
London and some excellence.
How are the Mets doing?
Okay, that's a good point. Let's talk about London football.
Well, you brought it up. You wanted to talk about it. Liz Ann Saunders coming up soon from Charles Schwab.
I'm looking for an entry point. I'm still in cash. I don't care what Liz Ann says.
With the First Word News, I'm Kaylee Lyons. President Trump is batting Democrats and Republicans over a proposed stimulus package. He's telling Senate Republicans to, quote, go big or go home when it comes to a proposal. But Majority Leader Mitch McConnell is only promising a vote on a paycheck replacement plan for small businesses. Meanwhile, House Speaker Nancy Pelosi says the White House plan comes up short. She's demanding significant changes. Supreme Court nominee Amy Coney Barrett avoided any major slips in a day of questioning on Capitol Hill. Senate Democrats asked her about abortion rights, health care laws, and gun and election disputes. Still, they made little progress, derailing Barrett's likely Senate confirmation. And Russian President Vladimir Putin and Saudi Crown Prince Mohammed bin Salman are urging OPEC and its allies to stick to agreed production cuts. That puts pressure on those members who haven't been living up to their promises. Oil prices are barely above $40 a barrel, and new coronavirus outbreaks are hurting demand. Global news 24 hours a day on Bloomberg, Quick Take, and of course on air, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg. This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
advanced economies doing better than emerging and developing economies, excluding China. Within countries, it's uneven. You're seeing low-skilled workers, youth, women doing worse in labor markets. So we're seeing rising inequality. This is why we describe this as a long, uneven, and highly uncertain ascent.
That was Gita Gopinath, the IMF chief economist, speaking to Bloomberg after an upgrade for 2020 and a downgrade for 2021. The recovery will be slower, the recession will be shallower. The message from the International Monetary Fund as the meetings commence. From New York and London this morning, good morning. Alongside Tom Keene and Lisa Bravis, I'm Jonathan Ferro. A busy one this Wednesday morning with the bank earnings coming through quickly. Let me just whip through the price action for you quickly as we count you down to the opening bell in New York, with equity futures turning lower, turning higher, unchanged on the S&P, and then lower again. Down 6 points on the S&P 500, off by a little more than 0.1%. The big move to the upside this week started Monday with big tech, the NASDAQ, up by about 3 percentage points on the NASDAQ 100 so far this week coming into Wednesday. In the bond market, huge rally over in Europe, particularly in Italy. Third largest bond market on the planet. BTP's rallying aggressively. We'll talk about it later in the next hour. In the Treasury market this morning, down a basis point to 0.71%. That's the story of the bond market. Here's the story of the bank earnings. Wells Fargo's third quarter provision for credit losses, $769. The estimate, $1.65 billion. So that is a downside surprise on credit provisions, Tom. That is a good surprise, and we've seen that from a series of lenders over the last day.
Yeah, as well, but it is, as Marty Mosby said, it's such a changed Wells Fargo as well. We're going to get to that in a moment. We've got the headlines coming out there on restructuring charges and that, but it is a different bank than the ones we've been reporting on. Right now on the markets, Lizanne Saunders joins with Charles Schwab, their chief investment strategist. And Lizanne, I've got up on the screen on SPX, you know, down 16% December of a few years ago, down 20-some% in the ugliness a year or so ago. And then, you know, in the recent pullback, down 9.9%. You have had the courage to stay in the market and participate. Justify that. How do you go through the process of staying in the market when we pull back?
Well, it depends on what you mean by stay. What we have been espousing, which is not terribly unique versus any other, quote, normal time in the environment, is not just stay, but be disciplined, particularly around things like periodic rebalancing. And specific to that, our message has been for investors that have historically done rebalancing on a calendar basis. They might do it on a quarterly basis or an annual basis, similar to what mutual funds do. They typically rebalance the last week in each quarter. But to let volatility be your guide as to when to rebalance, to have your portfolio dictate a message around rebalancing. So you're sort of trimming into some of these big pops in the market. You're adding during periods of weakness. It's not all or nothing decision making, but it keeps you in gear and forces us, of course, to do what we know we're supposed to, which is, you know, add low and trim high. So it's that rebalancing shift that we have been pushing this year.
Lizanne, just in terms of your approach to single names, what are you advising clients at the moment?
So, of course, I don't analyze individual stocks, but to investors who like to pick stocks, what we have been telling investors to focus on is factor more than either sector or style. And the factor that has been most consistently successful in this environment, really throughout the entire year, pre-pandemic, you know, into the bear market portion of this, and then since March 23rd low, is balance sheet quality. And even in sectors that have not been as dominant from a performance perspective, that quality factor has been leadership. So you can look for that quality basis. And I think factor in particular is more important than sector in this environment.
So, Lizanne, yesterday BlackRock chief executive Larry Fink came out after they reported that their assets had surged to nearly $8 trillion. And he said, I believe we still have more to go on the upside. He was talking about equities. We have a strong conviction that the average investor still is underinvested. Some people say he's just talking his book. Do you agree with him?
Well, it depends on what you mean by the average investor. You can break the market and investors into cohorts. I think the cohort that's getting a lot of attention recently, I've been calling the newly minted day trader. I'm not sure there's a lot of liquidity left there, but they're trading fairly small amounts. If you look at other measures of sentiment, certainly from an attitudinal standpoint, older investors, they're a little bit more cautious. But when you look at money market funds and the amount in there sitting there as sort of pseudo cash on the sidelines, I don't necessarily like that term, relative to overall market cap, it's a fairly low number, and cash in mutual funds is a fairly low number too. If you look over the long term at households' exposure to equities, it's down a little bit off the recent peak, but in kind of the highest quintile historically. So I'm not so sure I buy the argument that there's just massive amounts of money sitting there waiting to go into the market. I think it's a mixed bag.
Lizanne, I want to go back to something you and I know well, which is the work of Stephen Ross at MIT on factor analysis. You've got to talk more about this. I want you to explain why so much of what we do day to day within investment firms and within the newly minted ignores factor analysis, and what's going to be the variable out 3 and 5 years that drives Stephen Ross's original world.
Well, the newly minted day traders, the data we have, both anecdotally and then just looking at the activity among that cohort, clearly is not focusing really on anything terribly fundamental, be it valuation factors, long-term earnings growth. I think it's purely a momentum play, and that momentum can be in areas that may be justified by some fundamentals, certain tech-type stocks, but also just purely gambling plays, like some of the activity that we saw in areas like the bankruptcy stock. So I wouldn't sort of add that cohort in as making decisions based on any fundamental. I think the reason why the quality factor, and I agree, I think there will be increasing focus on factor-based decision-making, not just because of the positive bias it's had in terms of performance in this environment, but the realization that there's so much diversity within sectors that making that blanket sector call is probably not the path toward long-term investing success. That those factors around things like in this environment, quality, I think supersede a more simplistic focus just on the sector level.
Lizanne, great to catch up this morning. Thanks for your time. Lizanne Saunders there of Charles Schwab weighing in on this equity market. Wells Fargo, the numbers just out. We talked about them just briefly. The provision for credit losses lighter than expected. That's the good news. EPS coming in a little bit lighter than expected. I guess that's the bad news. And I would keep an eye on net interest margins from here on out. Third quarter net interest margin for Wells Fargo, 2.13%. The estimate, 2.19, slightly coming down. For our audience that aren't familiar with that term, Tom, it's the difference between the interest that I would pay for Lisa's deposits and the interest I would earn on your loans, and the difference between the two. Does that help?
Feral math, that helps. There's a 31-page Wells Fargo supplementary prospectus, and what's so important, John, is on page 3, they have bar charts, and they talk about above the regulatory minimum. It's a different bank.
More to come with Andrew Sheets of Morgan Stanley from London and New York this morning. Good morning. This is Bloomberg.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en unas en dos casas, en una 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esa enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
Failure of both monetary and fiscal policy is that the money isn't getting to the right people.
I think we're going to be stunned by the degree of earnings upgrades.
Monetary policy looks like it's pretty much on hold for a long period of time.
The numbers this year don't really tell us as much as we need to know about the future.
We've never had these kinds of numbers before. We've never had these trajectories.
It all comes back to the Fed. The Fed is very concerned about the outlook, whether it's L-shape or U-shape.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. What a day. 5, 6, 7 major stories, themes that we're driving into October. Of course, claims tomorrow on another 800,000 jobless and a key economic data. But, John, just simply an open question to you with all that's going on. What has your eye this morning?
The Italian bond market, and I know that feels a little bit off the beaten road at the moment, Tom, but right now, just rallying aggressively over the last couple of weeks. And we look at the spread of BTPs to German debt at the moment, that's about 120 basis points. That was as wide as 280 earlier in the year. That spread has just compressed, particularly over the last couple of weeks. That's one to watch, I think, in the debt market, Tom.
And that's bond price up, yield down as well. What's the why? Is it a flight to quality? Is it a flight to what?
Anticipation of more QE, perhaps one point. The other is reduced redenomination risk, and I'm not sure we're completely there yet, where we can say that this market now trades like a proper sovereign. What that means, Tom, we used to question how long some of these countries would stay in the Eurozone. The risk of redenomination, moving out of the euro, the single currency, and being repriced in a different one. The fiscal backstop of a couple of months ago, that Brussels deal, even though it's not been fully implemented, I think that gave some people the confidence that we have that now, and we've at least taken a step forward.
Let's redenominate over to the American scene, and Lisa Abramowitz, it is in Washington as well. What a difference. I just see from day 21 of the election, Lisa, from day to day 20 today, boy, did it heat up in the last 24 hours.
Yeah, and markets are responding in tandem with the different headlines. You see stocks vacillating here here. What I find interesting, just to build on what John was talking about, this bid into credit, even though it's uncertain what the future has to have with respect to the economic prospects, credit in the U.S. spreads, the extra yields that investors demand to own high-yield debt have fallen to pre-pandemic levels, even for the lowest rated junk bonds in the U.S., even as we have a lot of clouds overhanging here, even though the situation arguably, and frankly, if you just look at the unemployment picture, is much worse than it was earlier in the year. Tom, it just raises a question: how much is this fundamentals, and how much is this just a matter of the central bank fire hose of cash?
Well, as John Farrell mentioned, a debate tomorrow. It is not there. The data simply red and green on the screen. It's been a churn higher earlier, but we've come back and a churn to the markets right now. I'm not going to spend a lot of time on the data. Dollar weaker a little bit, and the 2-10 spread comes in from 61 basis points. A little bit of flattening over the last 2 days. Goldman Sachs out with really quite good earnings, popping over 2%. There's been any number of other bank earnings, but one of them that John Farrell mentioned was Wells Fargo. They are so distant from the romance of the stagecoach. Right now, it's about survival and the reconstruction of the San Francisco Bank. Shonali Basak joins us, our chief Wall Street correspondent here on Wells Fargo. What is different here, Shonali, about Wells Fargo? Where are they in that restructuring process?
Slow and painful in the middle of it, Tom. We see the efficiency ratio here above 80%. Compare that with Bank of America at 71%. They have a lot to do in terms of cutting costs. We already know they're cutting jobs. They're cutting people at every rank, the highest ranks at the bank. You have Charlie Scharf, of course, of former JP Morgan fame, former Visa fame, coming in here and putting in his own guard, though that change is slow, and investors seem to try to be giving Wells Fargo time, and we know there are the bulls and there are the bears for the Wells Fargo story.
Shonali, we've heard from 4 of the 5 big banks on Wall Street now. There's always a theme. What's the theme so far?
I would say costs, actually, John, because if you think about it, they all have been helped by, and you know, Charlie Scharf even said so in the press release. We've been helped by monetary and fiscal stimulus. How long does that gain last for? They have other pressures on their top line, but their costs are bloated. And some of these banks, we know, Bank of America, Morgan Stanley has committed to keeping people on through the end of the year. So where do they reduce the bottom? Where do they add changes there to expenses? And where does that go into next year? Are we going to see a massive pains in terms of headcount reductions next year?
Read layoffs. That's what headcount reductions will translate into. There is also a question about whether some of these banks will increase lending, given the fact that there is so much support on the fiscal side. We've known they've been tightening standards, reducing credit available to some smaller businesses, Wells Fargo doing the same. Any sign of what the future holds on that front, given some of the pressures that we're seeing?
Yeah, I'm glad you asked, because that data is very, very hard to find, Lisa. But when you look at the loan officer surveys to the Fed, it shows you that they are planning on reining in lending here. They are worried about the future, and we will see charge-offs into the end of next year. So the little guys might have a tough time finding a loan tomorrow.
10-year return, Wells Fargo, 1.9% a year. Wow, what a train wreck. Shonali Basak, thank you so much. Right now, Andrew Sheets joins us with Morgan Stanley. Always wonderful to have him on, truly on the dynamics and correlations of the market. Andrew Sheets, is the equity market alone here, or is it other markets that are adapting and adjusting to the expectation out there?
Well, good morning and good to be with you. You know what I think is pretty fascinating about both the equity market but a lot of different markets is that, you know, the headline levels speak to quite a bit of optimism. You know, we're back near the highs in the S&P 500. That would clearly suggest a quite optimistic outlook on the economy and events. And yet, I think across a lot of these markets, you still have a lot of the kind of the micro relationships, the intermarket relationships that reflect a lot of growth pessimism, right? Small caps still trade a historically large discount to large caps. Yields are still very low. The curve is still very flat. The ratio between high yield and investment grade spreads is still pretty wide. And all those things are what you would expect if investors were less confident about growth, not more confident. So I do think it's a pretty nuanced picture. Yes, you know, the headline indices are high. It's easy to kind of read that as, oh, there's an enormous amount of growth optimism that's come into the market. But actually, I think looking below the surface, what I think that would suggest is there's a lot more confidence, I think, on that there's a lot of liquidity in the market then there's a lot of confidence and high expectation that growth is going to rebound strongly.
Andrew, I might have misheard you. Did you just say that spreads are still pretty wide?
Yeah, so I know it might have sounded like a misquote. No, if we look at the relationship between high yield and investment grade, that relationship is still pretty elevated in the sense that high yield spreads have come in a lot less relative to higher quality spreads. And even within the high yield market, you still see pretty average levels of valuation gaps between, say, kind of single B credit and double B credit. So, our view is and remains pretty constructive on the credit space. Yes, it has rallied in. Yes, there's a lot less value than there was there over the summer. But I think this is an asset class that rarely trades at the average. And I think we're in one of those phases where we're moving from spreads being kind of too wide to probably the next phase being they need to move to being too tight.
All right, Andrew, John Farrow is just setting me up because he wants me to ask you, I'm sure, about the incredible amount of money that's poured into the CCC space and this question about whether we've seen the end of the bankruptcy cycle. In other words, are you saying that spreads are going to tighten because credit quality is perhaps underpriced right now, that basically investors aren't giving the benefit of the doubt to the likes of Carnival and Delta and these other companies that have yet to get back on board? Or are you saying that liquidity will overcome all of those concerns and they won't be an issue for creditors?
Yeah, so I think it's actually a little bit of a little bit between the two. I think actually would be a pretty common, pretty normal credit cycle to see the market rally and improve ahead of kind of ahead of the peak in the default rate, ahead of the worst of the downgrade cycle. We saw some of that in 2009, 2010, where the market had largely recovered in 2010, even as there were still quite a few downgrades to happen, even as many companies did go on and default. That the credit market, I think, does have some precedent of moving well ahead of those factors. And so, I guess what I would see it more consistent with is that kind of that normal cycle. That yes, you still will see downgrades, you'll still see defaults, but that the credit market has done, I think, a reasonable job of some differentiation there, and that those events won't be enough to derail the broader high yield market.
Andrew, you're so constructive, you're making Lisa depressed. Can you just tell me what would make you bearish? On a Sunday, when you write that Sunday Star note that everyone wants to be on the distribution list for, what makes Andrew Sheets bearish?
Thank you, John.
That note, when it comes out, what changes it?
Yeah, sure. So I do think the case for credit is better than other asset classes. We have less upside to our U.S. equity targets. We have less upside to our emerging market equity targets. I think those are markets that we do think are more fully valued than the credit market is. And I do think if we kind of think through U.S. election outcomes, and I think there's a lot of focus on what's the immediate market reaction to different combinations, but there are certainly combinations where you could inhibit further fiscal stimulus in the U.S. And I think that could be quite problematic. If you had to ask me, what's the broader scenario that would worry me most longer term, it's almost that we have a little bit of a Groundhog Day with 2010, 2011, where back then we were coming out of a recession, we were coming out of a really bad place. There was a lot of stimulus in the system, and then the stimulus just kind of stopped, and the market focus shifted to balancing the budget, fiscal austerity, and those types of things really slowed down the recovery. And so my concern would be that maybe you go through that again, that you've had this very sharp recovery off the lows in March and April, that actually kind of policymakers take their feet off the gas next year, and the recovery isn't as strong as we expect.
Andrew, great to catch up. Andrew Sheets of Morgan Stanley, and congratulations on the call so far in 2020. Far more constructive than the consensus through this year for an economic recovery. Not just Andrew Sheets, Mike Wilson on equities, Ellen Zettner on the economy in the United States. Chet and I are leading that research. Matt Hornback leading the rate side of things. Tom, quite a call from that team to be much more constructive on this recovery than most.
Absolutely. I mean, they've been on fire, particularly switching from a pretty negative call to positive. John, I'm looking at the Apple 10-year piece. It's yielding 0.63%. I mean, how much room there is there?
Tons.
It's just too wide, Tom. It's too wide. It's not my view.
10-year
Being
piece,
snarky.
0.63%.
I know. We haven't talked about the iPhone yet. We can do that a little bit later. Futures unchanged on the S&P. This is Bloomberg.
With the First Word News, I'm Kaylee Lyons. Prospects for another stimulus package before Election Day look bleak. President Donald Trump and Senate Republicans are at odds. The president is urging them to, quote, go big or go home. But Senate Majority Leader Mitch McConnell is only committing to a vote on the paycheck program for small businesses. Meanwhile, House Speaker Nancy Pelosi is demanding the White House revamp its latest offer. She says it's not big enough. Meanwhile, the world's top central banks are urging governments to keep spending. They say that concerns about mounting debt should be put aside until the economic recovery from the coronavirus is complete. The IMF is normally a champion of budget restraint, but the fund agrees that it is too early to end support. In the UK, there's growing pressure on Prime Minister Boris Johnson to order a circuit breaker lockdown. The opposition Labour Party and government scientists say it is needed to get the virus under control. Deaths have soared to their highest level since June. Concerns are mounting that Johnson's new system of restrictions are not enough. And Bloomberg has learned ConocoPhillips is in talks to buy rival Concho Resources. The company has a market value of about $8.7 billion. Conoco is looking to make a big bet on shale in the midst of a historic downturn in the oil industry. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We know that the economy is recovering, and we're not certain just yet whether the economy can stand on its own 2 feet and continue to deliver these strong credit numbers.
Gerard Cassidy, RBC Capital Markets head of US Bank Equity Strategy, weighing in on the financial results and the help we've had from the government. Wells Fargo, straight up, straight out, just acknowledging that help and attributing the results of this morning to the help they've had on the monetary and the fiscal side. Many others would say the same thing. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. 1 hour, 12 minutes out from the opening bell. Your price action shaping up as follows this Wednesday morning. Futures, they go nowhere. Euro dollar 117.55, firmer by 1/10 of 1%. I know I just pulled you in a little bit, Lisa.
That was great.
Got you
That was
excited
good.
and then
Well done.
nothing.
Yep.
In the bond market, nothing. Yield 0.72%. Question of the morning.
Selling it.
Does Tom Keene get the iPhone 12? That is the only question that matters. Is he a buyer or a keeper of what he's already got?
I'm not there yet because this has a great battery. I got it for the battery. I don't know. John, what I will say, and I covered this early this morning, is a chip. The A14 chip is just stunning. The improvement in the underlying engineering of the toy. And you'll see from there, John, I don't, that's my take on it. Alex Webb giving us perspective from London earlier this morning. Right now, on the reality, which is if you're a shareholder of Morgan Stanley and Goldman Sachs, guess what? It's been a lousy 10 years. You compare it to a lot of other things out there, given all the challenges, it hasn't happened. Fortress Gorman, okay, 8% a year, maybe 10-year return. Goldman Sachs, totally unacceptable, under 4% return per year. Christian Ballou, holding court at Credit Suisse, and particularly at Bernstein, joins us now with Autonomous Research and their senior analyst. Christian, you are long these guys, and particularly long Goldman Sachs. How do they do better than the terrible performance of the last 10 years?
Good morning, Tom. I'll try and help you on Goldman. I don't know if I can help you on the iPhone, though, the iPhone 12. On Goldman, look, I think there are many differences this cycle versus last cycle in terms of business mix. I think the lack of onerous incremental regulation, just generally how well managed these companies are relative to the life cycle. So I do think there are better prospects for both the brokerage stocks, Goldman and Morgan, headed forward. And you've seen that somewhat this year in a recession, in a somewhat tough environment. For example, this morning, Goldman putting up almost 19% ROTCE, which really was best in class relative to the other banks that have reported so far. So I do think, knock on wood, this time is somewhat different.
I look at this. This time is different. It starts with management. The belief over 10 years, going back to Brad Hintz at Sanford Bernstein, is that, they're really in it for themselves. They're really not doing it for the shareholders. What's changed?
Well, today's results are a really good example of what has changed, right? So, for example, a big part of the really strong results is discipline on compensation. And that speaks to a business that's far more geared towards sort of platform businesses versus people businesses, which allows far more operating leverage. Now, clearly, this is still a talent business, and you still have to pay up for performance, and you still have to attract the very best. But with the business mix and the focus on efficiency, again, like this morning, they can put up decent results.
Christian, platform business versus people business and efficiency. It screams job cuts. How big will the job cuts be next year on Wall Street?
Yeah, no, look, I think, I think broadly speaking, just generally speaking, you've seen cuts on Wall Street over the last decade for the most part. And as you see automation increase, digitization increase, electronic trading increase, there's probably still going to be, some more cuts. It is inevitable. That said, there are also opportunities that come through. You've seen the likes of Goldman Sachs, for example, recruit far more heavily in engineering type disciplines and technology type disciplines versus what they would have traditionally, 10, 15 years ago. So I do think, to your point, that there will be some headcount rationalization, but I also think there's a lot of opportunities in areas like technology to bring on new talent.
Which bank right now, based on the earnings results that we've gotten so far, are you most impressed by?
Yeah, so I look at Goldman and Morgan. So it would have to be Goldman, I would say, so far. And again, just looking at the returns today, kind of speaks to that. I would say more broadly speaking, if I was kind of thinking about the more broad strategic direction of the companies, we really like Morgan Stanley. I think James Goldman has done a really good job in changing the business mix. They've been very clever in the way they've used excess capital to really remix the business by buying E-Trade and, very recently Eaton Vance. Almost 2/3 of that of Morgan Stanley will come from, capital-like businesses like wealth and asset management. So overall, I would say Morgan Stanley, in terms of thinking about the long term and strategic direction, Morgan Stanley is the stock we like the most.
Kristen, before we let you go, just on the acquisition option, it's an option that's not available for many of the other big banks. It's an option that could be available to Goldman. Why do you think Goldman hasn't gone in that direction?
Yeah, so, look, I think, again, Morgan Stanley is somewhat more advanced strategically than Goldman, right? A newer management team, less in the way of capital flexibility. So I do think they're somewhat behind strategically to Morgan Stanley. And you need to know where you want to go first and be very clear on your direction before you go out and do deals. But I do think they will be in the conversation for acquisitions. They're beginning to build capital now, and they've always spoken to wealth management, asset management, and digital consumer banking as areas that would benefit from scale acquisitions. So I do think Goldman will be in the conversation for acquisition going forward.
Kristen, looking forward to getting you back on the show soon. Look forward to it. Kristen Bolu there, Autonomous Research Senior Analyst on the banks. Goldman in the pre-market, up by about 2.27% on Goldman Sachs stock. Morgan Stanley tomorrow morning. Tom Keene, 7:30 Eastern. That's when we'll round out the big bank earnings with Morgan Stanley.
To me, it's fascinating. I mean, the last 5-6 days have been really amazing here, talking about the banks into this, and we're in the process of this, the pandemic and how they're doing. And John, I'll be honest, I don't know what to make about it, other than clearly, as Christian just said there, Morgan Stanley has an action vision, and to be honest, we're all looking for action from the others.
I think it's still a wait and see for 2021, Tom, for so many of them. This is the guessing game on the provision side. Then the realized losses come further down the road. But all of 2021
I don't
and
agree.
the trajectory of 21 hinges on what we decide down in Washington, Tom.
You
don't agree the recovery hinges on D.C.?
I don't know. I'm looking for an entry point on Apple, but I'm also looking for an entry point on J.P. Morgan. I'm just losing as I go.
Apple earnings, 2 weeks tomorrow.
Evergreen quote.
This show. I know. Deep breath. One more segment.
You can do this.
I got it. This is Bloomberg.
कोरोना फैला हुआ है चारों तरफ। इस कोरोना के दौर के अंदर ये प्रदूषण हमारे लिए जानलेवा हो सकता है। एंटी स्मॉग गन्स काफ़ी बड़े स्तर के ऊपर जगह जगह लगाई जा रही है ताकि इसको रोका जा सके, और भी बहुत सारे कदम उठाए जा रहे हैं एंटी डस्ट कैंपेन के तहत।
Time will never come back. That was indeed a heaven view. There was less pollution. But now festive season is coming closer day by day. And again there will be same pollution, same problem.
जब कोरोना नहीं था मैं तब भी मास्क यूज करती थी, आज भी यूज कर रही हूँ, तो मेरे लिए तो कोई भी चेंजेस नहीं हुए वहाँ।
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. GZ from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
From New York and London, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. 1 hour away from the opening bell in New York City. Changed. In the bond market, not much action either. Nor on euro-dollar at 117.57, just slightly firmer there as we await the PPI data coming in from America. There it is, and here is Michael McKee.
Well, John, PPI doesn't carry the excitement it used to, but we are seeing a little more inflation, at least compared with PPI in the last month. The PPI for final demand up 0.4 on a month-over-month basis. That's double what the anticipation was. It was up 0.3 the prior month. Ex-food and energy, 0.4 gain as well. That was also double what was expected. On a year-over-year basis, we finally get a positive reading. In August, the PPI was negative 0.2, but in September, it is positive 0.4. So a string of fours across the board there. And the core rate for PPI is at 1.2%. That's a little better than the 1% expected and certainly up from 0.6%. 2/3 of the rise in prices, the BLS says, is attributable to a 0.4 increase in the index for final demand services. Services, of course, is what changed this index. They added services into the factory gate considerations, and it's become a little bit even less decoupled from consumer prices than it had been. But we do get a read now on what the services industries are doing, and they were up 0.4 on the month, the same as the overall headline. Final demand for goods also moving up 0.4. So 4 seems to be the Sesame Street number of the day, guys. And the question is, does it really show inflation, or is it just kind of a reversion to the mean?
That's where I want to go, Michael McKee. Everybody used to stop in a PPI, and then it became out of vogue, and it's sort of coming back into vogue right now. How many months in a row, Mike, do you need a trajectory to indicate an inflation trend off of the disinflation that we saw in final demand? How many more months of data do you need to say inflation?
Well, you have to consider that this is inflation. It's just very low inflation. To get accelerating inflation, you need 2, 3, 4 months of it at the core rate because we want to strip out food and energy, particularly in this case, even more so than at the consumer price level. And then you have to kind of look at it in tandem with consumer prices because companies have gotten very good at squishing prices between the factory gate and the retail shelf along the middle of that. And so until you want... what you're looking for, what you want to figure out is what the inflation rate is that affects consumer and business decision making, and that would take a lot more than we're getting right now in the PPI.
On claims tomorrow at 8:30, no doubt Michael McKee will join us with that hugely anticipated statistic. Right now, this is a joy. Michael Ferroli came out of Booth School Chicago and New York University as a Fed economist and joined a small bank in New York called J.P. Morgan. He wrote for Mellman, he wrote for Kasman and the others, and within their weekly prospects defined in this nation this odd phrase, potential GDP. John and Lisa have a whole bunch of questions for Dr. Ferroli on where we are right now. Michael, I want to go back to your initial acclaim on potential GDP. Do you adjust that statistic because of the pandemic?
So I think that's an open question right now. Normally, a really bad recession would lead one to lower their estimate of trend GDP growth because there are longer run impacts from short run events like recessions. However, I think it's a little early to say right now because this recession was so short and the recovery so far has been robust enough that I think it's an open question. So for example, normally one would say that the slowdown in capital spending after a recession would lead to slower productivity growth. Right now, it's not clear how much capital spending is actually slowing. We obviously had a bad second quarter, but a good rebound in the third quarter. So I think the jury is still out. It's something we've been considering quite a bit, but right now we're leaving our estimate unchanged at 1.5% for potential GDP growth.
Michael, since an increasing number of people are saying the same thing that you are, that this economic recovery has been more robust than people had expected, and that the recession perhaps a bit shallower, does that mean that there is a greater chance of bigger inflationary pressures given the amount of money that the federal government has thrown at this?
At the margin, yes. Better growth should lead to better, firmer inflation outcomes. It's still the case, however, that unemployment looks like it will be elevated for several quarters to come. So while we may revise our views towards somewhat higher inflation, it's still going to be inflation that we think will remain below the Fed's 2% objective for PCE inflation at least. So directionally, I would agree with what you're saying, but I wouldn't want to take it too far and say that we're looking at a big inflationary year to come.
Michael, we talked about this before. I just wonder how polarized the conversation is with clients at the moment on this issue, on inflation.
Well, inflation's gotten interesting. So we obviously had a few weak months around during the worst of the pandemic. We've had a few strong months since. A lot of that strength has been reversing some of the categories that were weak during the pandemic, but it has kept the discussion alive. I think it's, in my opinion, I think we are in a disinflationary environment. And as you say, the discussion, I'm sure it's polarizing as much as it was perhaps in 2009 when we first were experimenting with expanding the Fed balance sheet. But people definitely are interested in it, particularly given the central importance now it has in the prospects for a future Fed rate hike.
We caught up with Catherine Manor-City yesterday, and she brought up a series of issues. I'd love your thoughts on them. She was talking about the gap between consumers' perception of inflation, statistical measures of inflation, and financial market pricing of inflation. Michael, how do those three different things, what's that spread look like at the moment?
Right, so I think financial market expectations are closer to what you're seeing in the actual statistical measures of inflation. I would say consumer perceptions of inflation are higher. I think one of the reasons for that is that consumers tend to put more weight on prices that are more salient. So, for example, food prices tend to seem to carry more weight in consumers' perceptions than they do in the actual baskets of goods and services. And food prices have been a little firm recently. So I think that may be one factor that is leading to that disconnect between consumer perceptions and either financial market expectations, which are, remain relatively depressed, or, the actual measures like core PCE, which is also subdued right now.
Michael, how does real estate play into our guesstimate of new inflation? How do rents play in, owners adjusted rent, et cetera? How does ownership of homes play in to our guesstimate or reality of inflation in 12 or 36 months?
Yeah, this is actually a pretty interesting issue because both tenants' rent and owners' imputed rent, which is the rent people who own their homes would be paying, hypothetically, if they had to rent those homes. Both of those have decelerated very sharply in the past 3 months. Some of that may be due to a phenomena that is similar to what we saw in the early 2000s, which is when there's a very hot housing market and everyone's rushing to buy a house, what you see is weakness in the rental market. So it may be a bit of a statistical mirage in a sense, but nonetheless, it will feature pretty prominently because those measures are over 20% of the core PCE basket that the Fed looks at so carefully. So it may be sort of an odd byproduct of a hot housing market is a depressed set of rental measures for inflation.
Michael, pushing forward the next 6 to 12 months, how much does your unemployment forecast vary depending on whether there's a fiscal support plan passed in Washington or not?
Yeah, it could vary quite a bit because the growth outlook could vary quite a bit. If we got something like, some of the numbers have been coalescing around $2 trillion recently. That's 10% of GDP. Even if you haircut that for, people saving some of that stimulus, that would still have a pretty significant effect on GDP growth. And, as GDP growth goes, so goes with some adjustment the unemployment rate. So clearly this is, the markets are not, I think, misled to be focusing so intently on where fiscal stimulus negotiations are going.
Michael Feroli, I don't get much gloom out of the House of Kasman, but you had that chart on the trade deficit and weekly prospects this week. Tell me about the twin deficits. Do you link together our trade deficit and our new and enlarged fiscal deficit into something that you need to think about, study about, write about, and we need to understand?
Yeah, so, one of the interesting things is normally in recessions, the U.S. trade deficit tends to contract because U.S. demand for imports tend to contract more than foreign demand for exports. That hasn't been the case in this most recent recession, in part because it was unusually global in nature. So usually the U.S. kind of leads the global recession. This time everyone partook of the recession in a way equally. And so that was one factor, I think, that contributed to this widening of the trade deficit. The other thing is that given the nature of this recession, the U.S. Actually runs a surplus in trade and services. However, trade and services has contracted quite a bit given the inability to maintain social distance in many of those services. So we think it's that widening the trade deficit may partly be due to fiscal deficit concerns, fiscal deficit issues, but I think it's also partly due to the global nature of this recent slowdown.
Michael, great to catch up, as always. Send our best to the team, won't you? Michael Ferrari there, JP Morgan Securities Chief, US economist. Lisa went through the Fed speak about an hour and 40 minutes ago when we started this program, and how refreshing it is not to care too much about what anyone at the Fed's got to say at the moment, Tom. It's an absolute snooze fest, and maybe that was the objective.
Yeah, I think that's the objective as well, and they're waiting for fiscal stimulus. I mean, I saw an article, 2 days ago, that is just presumed fiscal stimulus the end of February. John, we've got to get there, and so does the Fed have to get there. Let me look here. Folks, you can do this quickly on your Bloomberg terminal in your car, FOMC Go, and then, John, I roll over to 2021. Again, you can do this in your car, particularly if you can see the screen, and it's March 17th.
Don't do this in your car.
March 17th, John, next year. That meeting, March 7th.
November 5th.
Are we going to have fiscal stimulus?
5th is the next meeting.
No, but
November 5th is the next
March
meeting.
17th.
That's interesting.
John, you're missing my point. You're focusing on Ronaldo.
All right.
He's doing well. Ronaldo's doing well.
That's good to hear. Thank
John,
you.
March 17th next year is when we're almost certain to have fiscal stimulus. Says who?
Says you, apparently. March 17th. I look forward to March 17th. Go on, Lisa, get it back on the rails.
I'm enjoying this. No, I want to let this keep going. Keep going, guys.
Ireland
Where are you
is
going
to the
with
west, John. Ireland's to the west. Irish holiday.
I will say,
March 17th.
okay, I'll get this back on the rails, John. I am looking forward to some of this Fed speak, in particular on regulatory issues and asset prices. The question of how much will they let asset prices go up? See, there's
John,
that.
she could bring a bar to silence in about 4
I can bore everybody.
Operation Get Me to the 9 o'clock, alongside Tom Keane and Lisa Abramovich.
There's a
Jonathan
Fed
Ferro.
headline just out. We'll have it for you in a bit.
Awesome. This is Bloomberg.
With the First Word News, I'm Kaylee Lyons. President Trump is battling Democrats and Republicans over a proposed stimulus package. He's telling Senate Republicans to, quote, go big or go home when it comes to a proposal. But Majority Leader Mitch McConnell is only promising a vote on paycheck replacement plan for small businesses. Meanwhile, House Speaker Nancy Pelosi says the White House plan comes up short. She's demanding significant changes. Supreme Court nominee Amy Coney Barrett avoided any major slips in a day of questioning on Capitol Hill. Senate Democrats asked her about abortion rights, healthcare law, guns, and election disputes. Still, they made little progress, derailing Barrett's likely Senate confirmation. The UK is signaling that it will not walk away from trade talks with the European Union immediately. Prime Minister Boris Johnson has set tomorrow as the deadline for an agreement. Still, negotiators are expected to keep talking past then. Johnson and the European Commission President Ursula von der Leyen discussed the impasse today on a video call. And Eli Lilly has put its clinical trial of a virus antibody treatment on hold because of a potential safety concern. Lilly is not saying, however, exactly what that concern is. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep keep on.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
There's a lot of nightmarish scenarios booked into things, and if it turns out that the reality is a little better than your nightmare, then I think there's a lot of revision that has to go on, and that revision will be a very positive force for the markets and for the economy.
Jim Paulson there, Luthold Group Chief Investment Strategist. As we count you down to the opening bell in New York, futures pretty much flat all morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Looking ahead to the market open, Jim Keenan of BlackRock will be joining us in around about an hour's time. David Kelly of JP Morgan also with us. Ashok Bhatia of Neuberger Berman. Dan Ives of Wedbush.
That's a brilliant set
We'll cover
of guests.
Apple. I'm still going. We'll cover Apple.
These are guys
We'll
that don't want to
fiscal
get up
talks.
early. I get it.
Bankruptcy.
He's just going to let that go. That's what John's going to do with that one.
Just flicking that one off. Carry on.
Very good. John Farrell, thank you so much. On Bloomberg Radio and Bloomberg Television as well. We're thrilled you're with us early or mid-morning as you can be. Red and green on the screen right now. Right now, Barry Ritholtz with a really, really, really important conversation. Of course, we look at Bloomberg Wealth and also Bloomberg Opinion and his skill sets about actually getting through the financial and investment storms. Barry, I want to talk about product development and the new. You and I have lived this right now. Maybe it's ESG, maybe it's, what are they called? Special purpose acquisition companies, whatever it is. Barry, you and I know this all happens at an 11 a.m. meeting in a skyscraper in New York where 6 people sit in a room and go, what can we do to package a new product to excite people? I mean, that's how the game's played, right?
That's right. And the history of modern Wall Street and modern finance has been a sequence of product developments going all the way back to mutual funds, structured products, decimalization from fractions to decimalization to trading, to ETFs, ESG, SPACs, CDOs, CLOs. All these new products come out because it's a new and clever way to try and generate return without ratcheting up your risk. And most of them, they all seem to fail.
Okay, but Barry, what's so important here, and I'm gonna defend Arthur Levitt and all on decimalization. I mean, I still love to quote Anaconda Copper by 3/8. And again, fractional shares, I think there's a huge value there. But on the manufactured products, how can our listeners and viewers, how can they defend themselves against the marketingness of it and yet get benefit from investing in tangible investment assets?
Well, I'm gonna take a line from the venture capitalists of the world who describe how can you identify a first mover and a pioneer? Well, they're the ones who have the arrows in their back. And there's no reason to rush out and try the latest and greatest anything. Whether it's ETFs or ESG or SPACs or what have you, ETFs have been around, 30 years now? You didn't have to be an investor in 1990. You could have given it a little while, let it shake out, and eventually we come to realize, hey, ETFs are an enormous improvement on mutual funds, if for no other reason than their tax efficiency is so superior to mutual funds. And when we look at SPACs, they've been around for just about 20 years, so it's a product that has proven itself. The problem is that people seem to forget a handful of these products have done well, and most of them, at least according to the most recent research, most of them are money losers.
Okay,
And so
Barry, let's dig into this because the SPAC rage has been a rage, and we've had a record amount of money raised this year for these vehicles, which basically are blank check companies giving a management team of the likes this year of Bill Ackman, Billy Beane of the A's and of Moneyball, Gary Cohn, and now Masayoshi Son of SoftBank getting in on
You've
this.
been on this all week.
Well, I mean, I just find this fascinating. You know, do you see this as peak SPAC, or do you think that this just indicates that there's a lot of enthusiasm that has legs to keep running?
So,
yes, peak SPAC.
I wouldn't say peak SPAC. I would say you have just read a list of investors, some of whom have a spectacular track record, and some of whom have a spectacularly terrible track record. I guess if you like WeWork, then by all means, go buy the SoftBank SPAC. That sounds like fun. I have to point out, you mentioned Bill Ackman, whose track record is outstanding, but you have to mention the man who is the reason why SPACs have gotten as popular as they have, and that's Sir Martin Franklin, whose track record in rolling out SPACs in the mid-2000s was nothing short of spectacular, 1,000% and up returns on multiple SPACs. And because of his specific track record, because he's done so well, lots of other SPACs have come to the fore. And, you know, Usain Bolt is really fast, but that doesn't mean anyone can grab a pair of Nikes and some gym shorts and set world records. And that's the environment we're in now.
Right.
Everybody wants to remember the commercial, Be Like Mike. Everybody wants to be like Michael Jordan. Everybody wants to be like Martin Franklin. Very, very few can.
I do want to just say, and Tom, you know, honestly, I think people like SPACs because of all the acronyms. You could do spectacular. You could do all sorts of things that are very funny and wonderful, Tom.
Barry, we've run out of time. We got to do this again. Huge value here. This
Whenever you like.
Whole idea of new products. Well, Mr. Ritholtz writing for Bloomberg Wealth, Bloomberg Opinion as well. Ritholtz Wealth Management. They manage money and try to buy more Apple every single day. Lisa, we hardly covered Apple in this hour. It's a scandal.
It's a scandal. I'm sure that it's going to be a scandal on my bank account, frankly, after my children watched the 1 p.m. Conference of the new iPhones. And they really seem to be bifurcating it with the high-priced ones and then one
Yeah, but I
SE.
have trouble with this. Lisa, I'm so glad you bring this up. Look, this is not about buying a $600 phone or $1,000, whatever they cost. They have got us into a utility mentality of a monthly plan, whether it's $50 or $60 or $75. And the media, Lisa, doesn't talk about this enough.
I totally agree.
It's in a total cash flow. You know, granted, if you buy 1, 2, 3, 4, 8 phones, it adds up. But these are not $1,000 purchases. 85%, I believe, are monthly purchases.
Yeah, I do want to say this is sort of a very important turning point, though, for Apple, because for 3 years, they've seen the replacement cycle decline, people keeping their phones for longer. I am guilty of that. I believe you are, too, because you really love the battery. But going forward, can they get people, can they entice people to switch out their phones, whether it's monthly or whether it's $1,000 payment all up front? And that's the big question. Yeah, go ahead, Tom.
I've heard it like 14 times, Lisa. Apple's done. They're going to die. Larry Havard and I sat on Fifth Avenue once at the store listening to all this gloom around us, and the great Lawrence Havard, he said, "What?" And it did.
Keep looking for an entry point, Tom.
I'm looking for an entry point. NASDAQ up 0.2%. I need to see it go down 0.1% before I load the boat. Stay with us on Bloomberg Radio, on Bloomberg Television. Good morning.
ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
The second half will be a lot stronger than the first half in China. We're heading to what we call the golden season of auto sales.
We are very confident, we're going to have another big growth, 2021 versus 2020.
We did not see people kind of holding back.
Chinese customers are into, right now, buying individual mobility.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
From London and New York, for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes ahead of the opening bell. Equity futures up 7, we advance 0.2%, and we begin with the big issue. A $2 trillion game of chicken playing out on Capitol Hill.
Markets are quite focused on stimulus.
Another very big round of fiscal stimulus in the U.S.
I think you need it pretty badly.
There's no doubt that the real economy needs extra stimulus.
They're right to expect it'll come.
Hopes have ebbed and flowed quite significantly about the chances of a deal.
That's what we need, is some stimulus to carry us through.
Roller coaster sums it up very nicely.
The market's convinced, I believe, that we are going to have some kind of stimulus.
It looks like it's on life support.
It's just a matter of when it's going to occur and then what the magnitude's going to be.
Uncertainty around timing and size of the fiscal stimulus.
If we don't get stimulus,
Fiscal is not a given.
it's going to be a very difficult recovery.
Well, prospects for another stimulus package quickly dimming with just 20 days until the election. Speaker Pelosi refusing to back down.
I want this very much now, because he was giving them a false thing. Just because the president wants to put a check with his name on it in the mail, that we should not be doing all we can to help people pay the rent, put food on the table, to enhance benefits, that they don't lose their jobs if they're state and local.
And with partisan tensions rising, fractions emerging between the administration and Senate leadership. President Trump undercutting Majority Leader Mitch McConnell after announcing plans for a vote on a smaller bill. The president tweeting, quote, "Stimulus, go big or go home." And where's Treasury Secretary Stephen Mnuchin going to be, you might ask? He's reportedly heading to the Middle East next week. Let's bring in Kevin Cirilli, shall we? Bloomberg Chief Washington Correspondent. Kevin, does anyone in Congress actually want to make a deal down in D.C. before this election?
President Trump does, and based upon conversations I'm having, they view this as, again, an opportunity to get something done before the election and to get some type of momentum that they so desperately need at this point in the campaign for president. Meanwhile, the dynamics that are increasingly becoming more volatile, not just for Republicans in the Senate, but also for Speaker of the House Nancy Pelosi. She has made the strategic move that she can stare down President Trump, stare down Leader McConnell, McConnell and not blink as it relates to a stimulus deal ahead of November 3rd. However, she also now is dealing increasingly with rank and file members who are very frustrated that they are not able to get to some type of deal. I've spoken with them all throughout this week, and what I can tell you is that they don't want to have to go home, Jonathan, empty-handed. Let's pull up a quote from Speaker of the House Nancy Pelosi and what she said yesterday. You played that Wolf Blitzer interview. She went on to say, quote, "Tragically, the Trump proposal falls significantly short of what this pandemic and deep recession demands. Significant changes must be made to remedy the Trump proposals, which she's calling deficiencies." In the sticking points in what we're talking about, the inclusion of a child tax credit, the amount of aid for childcare, aid for small businesses, and of course, the state and local governments. But I will note here, when you have to compare this you can't look at this in a vacuum. $1.8 trillion coming from the White House that they're put forth now, significantly more than the $560 billion that Leader McConnell had originally called for, and still significantly more than the amount of money that they passed in a stimulus in 2008. This is a massive amount of cash, and even if Speaker Pelosi is unable to get to a deal ahead of the November 3rd elections, her bargaining power, Jonathan, one could make the case diminishes in the lame duck.
Oh, well, Kevin, it's political posturing, isn't it? And we've seen this play out before. The issue that Speaker Pelosi has now, I'm not sure who that quote is for, whether it's actually for a general audience or her own party who are pushing back and saying, call McConnell's bluff, call the administration's bluff, agree to a deal. We know it won't pass the Senate.
Yes, and especially now she has to navigate with the flank of her party as well as the rank and file members who are also looking. I mean, $1.8 trillion is nearly the size of Apple, and so I think from a broader standpoint, it's all about timing, whether it happens before the end of the year. But regardless of the political landscape, mid-November or December, the bargaining and negotiating power for a Speaker of the House, there's questions about that. Yeah. And that's historical.
Hey, Kevin,
that
great
is
to catch
historical.
up.
Thank you. Yeah.
I get it. A busy morning ahead for you. Kevin Cirilli down in Washington, D.C. Here's your price action, 25 minutes out from the opening bell. Your equity market shaping up as follows. It just feels like we're turning the sound up and down, the volume on the same song for the last 3 months. But the track hasn't changed. I said that last week, and it feels the same way this morning. In the bond market, yields in a single basis point to 0.71%. Euro dollar not doing a whole lot, 117.60 on that currency pair. Neuberger Berman's Ashok Bhatia emphasizing the importance of fiscal policy, writing the following: with central bank policy on autopilot and minimizing downside risk for markets, fiscal policy will be a key driver for upside in the markets, and we may end up seeing unprecedented spending next year. I'm pleased to say that Ashok joins us now. So, Ashok, it used to be that we'd worry about a clean sweep, a blue wave, a red wave, whatever it might be, and divided government is what markets would welcome. Is divided government what markets fear now?
Yeah, I think, good morning, Jonathan. I think that's exactly right. I think for short term, and by that I mean the next few months and into early next year, divided government is probably going to be, at least short term, a little bit of a disappointment for markets at these levels. I think Kevin was just pointing out these spending numbers. The U.S. is running about a little over a $3 trillion deficit. That's triple from what we were pre-COVID levels. And regardless of whether we pass, this additional spending in some now or in a lame duck, we're on a trajectory for significantly higher fiscal spending. And I do think the markets are pricing, a reasonably high probability of a blue wave that takes another big leap in fiscal spending next year and creates some of this upside risk to the markets are pricing in right now.
Ashok, one question we've explored over the last couple of weeks on this program is just how quickly the narrative has flipped, almost out of nowhere after that first debate between President Trump and former Vice President Joe Biden. And a question I've asked repeatedly, Ashok, I'll ask it of you. How vulnerable is this fresh market narrative that everything's going to be great down in Washington for the next several months out into 21, and we'll get all the good stuff and none of the bad stuff?
Yeah, I think these narratives, as Jonathan just said, they are shifting rapidly. I would add one point. I think, part of why this narrative has shifted has not just been the apparent advantage Joe Biden has in the polls and some of the Senate polling, but it's also been some of these comments that, if he were to win and we get a blue wave, it would be a focus on spending near term with deferred tax hikes and things like that, some of the more growth negative issues. So I think that's a balance the market, at least short-term likes. So one risk would be if some of those, tax hikes and some of that deferred negative growth types of policies were to come back to be linked up immediately with higher spending. So even in a blue wave, if that policy mix shifts, could see that being a little bit of downside pressure for the markets.
So, Ashok, just on the 10-year specifically in the Treasury market, why do we have such a range-bound 10-year yield still, slap bang in the middle of the range of the last 5 months?
I think the short answer is the Fed has a lot of credibility and a lot of tools. And, the market is reluctant to take interest rates or government bond yields to significantly higher levels, knowing that the Fed could do things like expanded purchase programs, yield curve caps, all these, other sorts of tools that effectively pin interest rates. And in addition to that, we are seeing falls in sovereign bond yields. Italy, Spain, the pressure from negative rates in Europe continues, and that just creates some spillover demand into our government bond market as well.
Ashok, before I let you go, you mentioned Europe. That's been a trade a lot of people have talked about on this program, on this network. Long Europe in the bond market, peripheral debt really rallying in the last couple of weeks. Short treasuries. Are you behind that call too?
Yeah, we do think, short, intermediate term, there's a lot of interesting things that could happen in Europe. And by extension, the dollar. One of the things that just sticks out this year has been the continued weakness on a year-over-year basis in some, particularly in the emerging market currencies. We've obviously seen things like the euro and the developed currencies starting to trade a little bit better. But one of the other is we talked about narrative shifts that could end up occurring is, depending on the result, do you start to see more traction behind a weak dollar move more broadly, which would continue to help not just European fixed income assets, but really a range of EM as well.
Ashok, really good points. Looking forward to continuing the conversation over the next 12 months or so and beyond. Ashok Bally there on this market. Equity futures are firmer by 6 on the S&P. Ashok mentioned that weaker dollar. That's what's playing out in G10 right now. Top of the pile, sterling. We'll talk about that a little bit later at the market desk with your movers. Here's Abigail.
Well, John, the U.S. futures are up just slightly, so let's take a look at a few movers that are on the move just a little bit more. Starting out with Microsoft, this stock now on pace for its 6th update in a row, the first time that will happen since May. UBS is initiated with a buy rating. Palantir popping not on a lot of new news, but really as a barometer of some of the risk on tone. United Health had been higher earlier, now down slightly. They put up a strong quarter, and they also raised the forecast as costs remain low. We'll be looking into and reporting on what's now causing that stock to drop. And then finally, Grubhub up 5.3% as Dutch Eat Takeaway has given a positive update. The Dutch company is saying that they are on track to complete their $7.3 billion takeover of Grubhub. So unlikely to be an LVMH Tiffany situation. Grubhub shareholders liking that news this morning, John.
Abigail, thank you. Great work. We'll catch up with Abigail a little bit later in the hour. Coming up on this program, earnings in focus, the financials remaining in the spotlight. We're breaking down the latest results with Piper Sandler's Jeff Hart and JP Morgan's David Kelly. That conversation next on Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Banks are products of their economy. So the U.S. economy, as you know, is going to have some incredible growth in the third quarter, but that's more of a mathematical exercise to the second quarter. But if we start to see, 2 to 4% real GDP growth in the fourth quarter and first quarter of next year, then we're going to start to see the all clear signal for the banks to be able to grow. And that is going to be the challenge for 21, is growing those top line revenues.
RBC's Gerard Cassidy discussing the headwinds and uncertainties facing the banks this earnings season. All of the majors lenders reporting thus far topping trading revenue estimates, except for Bank of America. Bloomberg's Shonali Bassett joins us now for more. Shonali, on top of the figures over the last 24 hours, what's the theme?
The theme is that the big consumer banks are taking a beating as the economy is so uncertain that they're not sure that they can reduce their reserves. There's a real worry here that these credit losses will go well into next year, but the trading businesses, as we've seen, are doing okay. We have JP Morgan posting major gains, we have Goldman posting major gains, and if you take a look at this chart here, you see they're rising very significantly, and you wonder about how much market share they are really taking. Goldman coming in just shy of JP Morgan in terms of percentage increase as their equities fell a little lighter than expected. But all in all, Goldman is the one that's the real standout here, John, because they're able to post returns above 17% when it comes to return on equity. It's a real turnaround story, and it's a real difference from what we've seen in the last crisis.
Shonali, great work as always, and you see it in the stock price. Goldman up right now, 2% ahead of the opening bell. Piper Sandler's banking analyst Jeff Hart joins us now on the phone. He's bullish on most of the big banks, with overweight ratings on both Bank of America and Goldman Sachs. Jeff, great to get you with us this morning. I know it's super busy for you, so let's run through things just quickly. Do you like what you see so far?
Yeah, so far I think it's been pretty good earnings, at least from the big banks. I think the concern and what's kind of weighed on banks in general is, people are now looking past credit and kind of figuring we'll get through credit and what's the revenue environment going to look like after that. And sluggish loan growth and low interest rates kind of create some headwinds for banks in general. But when I look at the large cap banks, all the ones I cover, like Goldman Sachs, JP Morgan, I mean, they, I think, are well positioned to thrive in an environment where revenues are tough because they have scale, and scale will matter more than ever, and they have exposure to capital markets. So that's really been the bright spot as far as revenues have gone kind of since COVID. Both investment banking and trading have been strong, quite resilient, and the backlogs look good. So I think we'll see that kind of strength continue going forward.
Looking ahead to Morgan Stanley tomorrow, Jeff, what are you looking for?
I think we'll probably hear more of kind of what we heard, what we have been hearing both from JP Morgan, Citi, and then specifically Goldman today. Very good trading revenues, probably better than expected. Good investment banking revenues with building pipelines. And for Morgan Stanley, I think you'll kind of see that one of the interesting things for them is, they're going to start integrating E-Trade, and then you've got Eaton Vance. You've kind of got some execution kind of risk kind of creeping in there. So that'll maybe make them a little more interesting over the next couple of quarters. But I think we're going to get very solid results from Morgan Stanley's Ball tomorrow.
Jeff, just a final question from me on the kind of business model you think is set to succeed through the next 12 months and beyond. Is it the streamlined focus Morgan Stanley, or the more universal model, the big beast, the likes of JP Morgan, etc.?
I'm inclined to think in the near term you want to be more kind of overweight the investment banks, be it a Goldman Sachs or a Morgan Stanley, just from a business mix perspective, because they're light on net interest income and heavy on capital markets. But you get beyond that into next year, I think that the big banks, the G-SIBs are, at least in my mind, the place to be because they have scale, and scale matters more now than ever today.
Jeff, great to catch up, as always. I'll let you go. Jeff Hart there, joining us on the bank earnings. Sticking with earnings, JP Morgan's David Kelly blaming the coronavirus for interrupting the V-shaped earnings recovery, writing the following. We expect earnings to be down about 15% year over year this quarter, with the pace of improvement slowing in Q4 due to the pandemic and lack of further fiscal stimulus. 2021 earnings depends on how quickly and completely we end the pandemic. David joins us now for more. David, that makes it pretty difficult to have any kind of projection or forecast into next year, doesn't it?
Well, yes, it does. I mean, there's still an awful lot of uncertainty out there because we don't know how rapidly a vaccine is going to be developed and distributed, and we don't know if the whole public is going to get into this a united effort to squash the pandemic. It's not just about taking the vaccine; it's about everybody sort of working the same direction. So there's some question mark there, but the equity investing business is a long-term business, and we will get past this pandemic. And I think that later on next year, provided there is a vaccine, I think we will see some stronger growth. But in the short term, it's going to be rough after a very good bounce in the third quarter.
Well, David, you've characterized this as the V interrupted. Can you walk us through what you're set to see, what you think we're set to see in the coming quarters?
Yeah, well, I think, first of all, on GDP perspective, we were down 31.4% in Q2. We're going to be up about 35% in Q3, and then there's going to be a screeching of brakes because we're only going to be up about 3%, if that, in Q4. I think something similar in the first quarter of next year, and then we can begin to reaccelerate. But we're still going to be, half the economy is going to have come back. The other half, the entertainment, leisure, retail, and so forth, will not have come back and can't come back until we subdue the pandemic, and the pandemic's actually getting worse. So that's the V interrupted. It looks like a V right now, but it's going to slow down. That's also the case in earnings. Down 15%, we think, for the third quarter, maybe down 9% for the fourth quarter, but it's still going to be down year over year, in the fourth quarter. And I think we won't hit a new all-time high in earnings until 2022. We'll get there, but it's just not at the pace that we're seeing in the third quarter.
We might see a record high in the market again pretty soon, David. We're not far off it. You mentioned the K-shaped recovery, not the K itself, but you alluded to it. And I just wonder, the two legs of the K, the haves and the have-nots, those that are doing really well and those that are being left behind. Can we talk about the price of that story and which leg of that K is most vulnerable, just looking at how it's priced?
Well, I think that within markets, it's sort of a difference. Yeah, I don't think actually the markets are a very good representation of the K that's going on in the economy. And I think the financials are a perfect example of that, where they're not priced that expensive. They're sort of boring and everybody's kind of worried about them. I'm actually not that worried. I think we will get more fiscal stimulus after the election, both in the lame duck session of Congress and in the new Congress. And that should help reduce credit losses until you get that surge in growth later on next year. And then when you get that, I think you get a steeper yield curve, which will also help financials. So financials are being treated as if they are victims of this pandemic when they're really operating pretty well. But on the upper side of the K, there's certainly a lot of interest in mega cap growth stocks, a lot of money going into that area. And maybe that is a little bit overpriced because, in the end, valuations are really important here. And we're seeing this widening dispersion of valuations within a market, which, we are going to get past this pandemic. This is a sort of a 2-year event. And when we get past it, we need to think much more carefully about valuations.
But right now, what do you want to own, David? The financials or big tech?
I'd rather own financials, to be honest, because I have to have more than a 12-month view. I'm not going to try and time this thing. I think that's crazy. But also international. I mean, international equities in general are beaten down because people have had a very negative view on stock markets overseas, unlike here in the United States. And those do look demonstrably cheap relative to the U.S. So I think U.S. value stocks, financials, international equities, that's where I'd want to be a little overweight going into 2021.
It seems to all be part of the same trade, David. I hear it a lot. Anyone that tells me they're overweight or like the financials here in the United States, I almost know what's coming next. They like the international side of the story as well. How do you balance that out, David?
Well, because what's going on is people have forgotten about valuations. It is such a complicated world this year. I mean, companies are not even releasing guidance because they don't know how to figure out their earnings. If companies can't figure out their earnings, what are the analysts, what are the investors going to do? So what people are doing is they're going into momentum trades. They're buying large mega cap growth stocks, and they're also piling into, high quality bonds. Both of those look rather expensive in this environment. But what I'm saying is that as you get past the election, as you get past the pandemic, as uncertainty actually comes down, and it will come down, then valuations will be more important. And what U.S. value stocks, financials in general, international equities, EM, DM, what they all have in common is they look pretty reasonable in terms of valuations. I think that's what's going to play out well over the next 2 years as we get past this pandemic.
David Kelly at JP Morgan. Great to catch up, sir. My best to you and the team. Coming up on the programme, the analyst action you need to know. That'll be next in our morning calls. And later, Wedbush's Dan Ives joins us to review Apple's newly unveiled iPhones. That conversation still ahead. From London and New York this morning, good morning. With equity futures shaping up as follows on the S&P 500. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Five minutes away from the opening bell, equity futures up about 5 or 6 points on the S&P 500. We advanced almost 0.2%. Let's get you some morning calls, shall we? A look at some of the analyst recommendations on Wall Street this morning. We begin first up with UBS, downgrading Splunk by 2 notches, cutting shares to a sell from a buy, a 165 price target. The analyst expecting the company to lower its growth targets at next week's Analyst Day. Your second call from Wells Fargo, downgrading Kroger to equal weight, $34 price target. The analyst seeing headwinds to post-pandemic sales and less favorable risk profile. That stock is off by a little more than 1%. And your third and final call from Jefferies, raising its Apple's price target to 140. The analyst expecting a robust upgrade cycle fueled by increasing carrier promotions. That stock unchanged. One man very bullish on that stock. Wedbush Managing Director Dan Ives will be joining us very shortly, right here on Bloomberg.
when opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff, and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Wednesday morning, 20 seconds away from the opening bell in New York City, 20 days away from a general election in the United States of America, a $2 trillion game of chicken playing out on Capitol Hill over fiscal stimulus. The vaccine race hitting a speed bump. We'll talk about that in just a moment. Equity futures up 4 on the S&P, advancing a little more than 0.1% on the NASDAQ. That's the opening bell. Switch up the board in the bond market. Treasury yields coming down a basis point on a 10-year to 0.72%. In the FX market, euro dollar just a little bit firmer on the euro side to 117.60, and in the commodity market, $40 and about 90 cents. We advanced by around about 1.8%. That's the cross-asset picture this Wednesday morning with your movers at the markets desk. Here is Abigail.
John, let's start out with the shares of Qualcomm because the chipmaker is popping higher. The street's super positive after Apple, of course, yesterday revealed those new 5G iPhones, saying that Qualcomm is likely to be a primary beneficiary. Bank of America, in fact, has raised their price target to a street high of $165. We also have the shares of Moderna higher. This as the European Medicine Agency has said the company is eligible to submit an application for its vaccine for COVID-19. AutoZone, this is interesting, up 1.9% as Raymond James is now naming the stock a top pick, and also boosting the rating to a strong buy on the company's strong guidance given a couple weeks ago. So the analyst pondering this, liking it, also saying valuation is attractive. And then finally, take a look at the shares of Conto Resources soaring up 11% on a Bloomberg exclusive. The company, ConocoPhillips, is said to be in talks to buy Conto Resources for its Permian assets, and Conto has a market cap of about $9 billion, and that right now, John, seems to be helping the energy sector, the second best on the day right now, at least.
Abigail, thank you. Top of the pile, the industrials advancing around about 0.5% at the moment. Energy now top of the pile, advancing 0.5%. A moving target, the S&P 500 unchanged at the moment. Moving now to healthcare, the race for a vaccine stumbling with 2 pharma giants recently suffering setbacks. Eli Lilly becoming the latest company to put its trials on hold. Weighing in, Bloomberg Scarlett Fu joins us now for more. Hey, Scarlett.
Good morning, John. Yeah, looking at Eli Lilly stabilizing after a 2-day slide, saying Tuesday afternoon it's pausing enrollment in a clinical trial of its antibody therapy. A week ago, remember, Lilly had asked the FDA for emergency use authorization. J&J also recovering a bit here. Late Monday, a volunteer in J&J's study for its experimental vaccine got sick, and it's now halted the phase 3 trial, which is seen as one of the larger trials. Pauses during drug trials are not unusual, but these are not the normal of times, most normal of times, with companies accelerating what's normally a years-long process powered by the White House's $18 billion Operation Warp Speed program. The worry here is that political pressure may compromise scientific rigor. We know President Trump has promised a treatment before the election. Investors are also desperate for good news before the start of winter and what's expected to be another wave of the virus. Now, J&J's vaccine has some advantages over its competitors in that it does not need to be frozen, making logistics of administering it much easier down the road, and may work with just 1 dose rather than 2. AstraZeneca's vaccine also uses the adenovirus treatment. It's been forced to halt its trial twice and is still on hold in the U.S. Other frontrunners include Pfizer, which is working with BioNTech. It's furthest along the clinical trials, and it's using a messenger RNA technology. Moderna also developing an mRNA-based vaccine. Now, by contrast, Lilly is working on an antibody treatment, which is seen as more of a bridge to vaccines. As for what's priced into markets, here's where it gets interesting. Balyasny Asset Management's co-founder said the markets expect a vaccine that's only 50 to 60% effective. So that leaves room for beaten down stocks to rally if the vaccine ends up being more protective than that. John?
Scarlett, thank you. One of those companies could hold the key to the economic outlook for years to come. Scarlett Fu, thank you very much. Looking at this market, Apple down for a second day, down by around about 0.7% this morning. The newest iPhones fueling expectations for a new cycle of sales growth. CEO Tim Cook saying 5G is the most exciting step yet.
Each generation of cellular network technology on iPhone has enabled breakthrough innovations and entirely new opportunities for our developers and our users. And 5G is the most exciting step yet. For so many people, this all becomes real with 5G coming to iPhone.
Bloomberg's Ed Ludlow joins us now from San Francisco. Ed, I can get the phone. Can I actually get 5G?
Well, Apple addressed that head on, John, saying they tested with hundreds of carriers around the world. And as you know, ahead of this event, we'd reported that third parties, as well as Apple's own testers, had found that basically the speeds with 5G on the new generation were limited. But broadly, the reaction is positive from Wall Street, and there's a real focus on Apple's pricing strategy. With that iPhone 12 mini at $699, it makes the product more accessible because across the four handsets, you've got OLED screens, you've got updated cameras, you've got that faster A14 processor as standard. But if you look to the iPhone 12 mini, there's hundreds of millions of us around the world that have older generations of iPhone, and the consensus is that there was enough across the four handsets to spur that upgrade cycle. Equally, if you look at the iPhone 12 Pro Max, the most expensive handset with the 6.7-inch display, there's some exclusive features there, particularly around the camera, and analysts see that enticing consumers, even with the higher price point, driving average selling prices higher. And as you know, John, this is a saturated cell phone market where we see refresh rates and higher SPs being a bigger driver of revenue growth. There's also a really positive response this morning around the role that carriers are going to play. You saw Verizon CEO Hans Vestberg up on stage with Tim Cook. Verizon is going to offer to new customers that handset for free, the more expensive ones, not the iPhone 12 mini, as long as it's a new customer of a trade-in. AT&T are going to go a step further and offer it to existing customers. The feeling from Wall Street is that that's going to help with the affordability of these slightly more expensive handsets. And as I said, look, it's been suggested by some analysts that yes, 5G may not be pervasive in some US cities or in your community, but there is an element of future-proofing here, right? This is the most substantive technology upgrade from Apple in some time. The idea here is that consumers will buy the phone and wait basically until 5G comes to their city. I think the stock's a little lower this morning, but it's doubled since a March low, John, so I'm not sure if it's a case of selling the news. But broadly speaking, I think analysts on Wall Street like what they see.
Or you just wait for the next phone when 5G actually arrives. Ed Ludlow on the West Coast. Ed, always great to catch up, sir. Great reporting in the last 24 hours. Wedbush's Dan Ives also weighing in on this. Very bullish through this year, calling Apple's debut rollout a once-in-a-decade launch, writing the following: it's the most important product cycle since the iPhone 6 in 2014. That should translate into a super cycle for Cupertino next year. 350 million of 950 million iPhones worldwide are currently in the window of an upgrade opportunity, translating into an unprecedented upgrade cycle. Dan joins us now for more. Dan, let's just start there. What's the window for an upgrade opportunity? How do you define that?
Yeah, I would define that as those are customers that, based on our analysis, have not upgraded in 3.5 years. Now, if I go back to the last two cycles, that was about 25 to 28% of the install base. Now it's 40%. And that's really why the pent-up demand there over the next 12 months with this 5G phone, I view it as going into the Cupertino Hall of Fame as a super cycle.
Some people might say, Dan, it's like buying a Ferrari and only driving it around Manhattan. I understand lots of people are stupid enough to do that. But if you have a 5G phone that can't access 5G, what's the point, Dan?
Yeah, and look, and to that point, I would view it as over the next 3, 6, 9 months, 5G is on its way to getting to prime time, especially in the U.S. You know, obviously Verizon and everything have done the millimeter wave. And from an install-based perspective, it's the most transformational technology upgrade that we've seen from Apple since 2014 with the iconic iPhone 6. With that pent-up demand, I think this is enough, potentially, to exceed that peak year, 231 million iPhone units. And if that does happen, we're looking a year from now, $175 stock.
Dan, I know that 30 days isn't a big deal, but the launch of this phone is a month later, typically to what we would expect going into the holiday season. What does that mean for where you think these numbers will fall?
Yeah, obviously it moves it out a bit, but I think the key here, the line in the sand, is ahead of holiday season. Going into holiday season and into next year, of course, there's still some supply issues coming out of Asia. But if I look at, based on our checks, we've seen unit in terms of pent-up demand out of suppliers going up about 10 million, call it almost 15% over the last 6 to 8 weeks. That's a positive tea leaf. We'll see, when Apple reports numbers later this month. But it all comes down to China. China is the linchpin of growth for this to be a super cycle.
What happened yesterday with China, Dan, with the streaming issues? What was your read on that?
I mean, my read, that was, a retaliatory issue that we saw during the streaming, live webcast. You saw it throughout China. Many of the social media platforms took that down. And I think that's also why the stock acted negative, given this cold tech war between U.S. and China and where Apple stands. I view it as more of a noisemaker, although it does speak to the tensions. It all comes down to 60 to 70 million iPhones are a window of opportunity in China. And I think that
just want to get to re-rating to wrap things up, Dan, if I might. On the multiple, you and I have talked many times the importance of China. We've talked about the importance of the services business, and now it just feels like we're going old school again. The re-rating is about the hardware. Dan, can you speak to that?
Yeah, I think it's a great point, because for now, the hearts and lungs, the key to the upgrade cycle is putting that iron fence around the install base. That's what iPhone 12 is going to do in the super cycle. Then the next leg, the 1-2 punch, is the further monetization of that on the services side. But at least over the next 3, 6, 9 months, we get back to old school in terms of the super cycle. And if this is what I believe it can be, I think it cements really the next 2-3 years of growth for Apple, despite, the haters continuing to hate.
The haters will always hate. Dan Ives, you've been a lover, not a hater, and you've been right through much of 2020. Dan Ives of Wedbush on Apple. Thank you, sir. Apple stock, as Dan Ives speaks, turns positive, up about 0.8% on the session. Bank of America is lower in early trading. Listening to the call, here's Shanali Basak.
Thanks, John. You're seeing Bank of America down. Speaking of haters, right? A lot of their businesses are under pressure. In fact, most of them are down. And even when you look at the businesses that are up on the year, like sales and trading, they have missed expectations. So on the call, Bank of America still is telling analysts that they feel that they're gaining share in some of these trading businesses, particularly in equities, but their consumer banking business, that drop that you see there on that chart, that is worse than all of its other peers that have reported, barring Wells Fargo. So they're pretty steep declines. The longer-term headwinds in the economy are also concerning analysts, and the rush to gain market share as they look to open more branches at this time and pull in deposits. It's a very competitive environment out there, and they're looking to sell that story.
Shanali, thank you. Shanali's busiest week of the quarter. It continues tomorrow. Morgan Stanley tomorrow morning, 7:30 Eastern Time. Coming up on this program, retailers, restaurants, airlines, and now potentially movie chains. BlackRock's Jim Keenan joins us to discuss the growing list of companies blaming the pandemic for their looming bankruptcies. That conversation is next. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Let's call it 15 minutes into the session this Wednesday morning. Equities advancing on the S&P 500 by 1/3%, on the NASDAQ by 0.5. U.S. bankruptcy filings are piling up, with more than 250 companies citing the pandemic as a factor for their demise this year. Bloomberg reporting that the world's biggest movie chain, AMC Entertainment, could become the latest to consider a potential bankruptcy, and it could run out with cash by the end of the year. The CEO, Adam Aron, insisting the focus remains on fundraising, saying, quote, "We're going to throw all of our efforts now into raising additional capital, primarily equity, to lengthen our runway even more. We'd like to succeed in this effort. If we don't, obviously, we'll have to consider other options down the road." On this and more, Bloomberg's Sarah Ponczek. Good morning to you, Sarah.
Good morning, John. That's right. Well, another consequence of this COVID-19 arranged economy that we have been living in has been a wave of bankruptcies. And as BTIG's Julian Emanuel put it last night in an email to clients, he said, with the virus accelerating and questions about vaccine development surfacing, stimulus still a near-term unknown, a rise in bankruptcies could happen as winter approaches. Now, correlation may not be causation. However, if you look at here, what you're looking at is that white line is your Bloomberg Bankruptcy Index. That blue line is your 7-day moving average of new COVID cases in the U.S. What we've seen is that bankruptcy pickups have lagged pickups in COVID-19 case counts. Now, we are seeing a pickup in COVID-19 case counts once again, as you can see towards the right end of this chart on your screen. Now, what that does beg the question of is, if we are seeing a rise in COVID-19 case counts, does that mean further lockdown restrictions could be on the way, questionably, and what does that mean for further bankruptcies? Consider where we currently stand. So 204 companies with over $50 million in liabilities have filed for bankruptcy this year. That's the most since 2009, when that comparable number was 239. As for what sectors have been most affected, consumer discretionary and energy make up more than half of the pie. On top of that, you see industrials, also healthcare, but very much cyclically oriented. Some of the largest bankruptcies this year have included Hertz, Ascena Retail, Chesapeake. You mentioned AMC. We will see what happens there. The CEO is denying those claims of those Bloomberg reports and saying that they will continue to focus on raising capital. Now, what have investors been doing in this time, though? Well, they've been focusing on companies with strong balance sheets. This even as we've seen credit spreads really narrow at the same time. So Goldman Sachs has these baskets that they track. One, companies with very strong balance sheets, one with weaker balance sheets. And if you look at the comparison, what we have seen this year, that white line is that strong balance sheet index versus that weak balance sheet index. Even as we have seen credit spreads narrow, that has just continued to trend higher. I'll give you those numbers. That strong balance sheet basket this year up 28% in 2020. Meanwhile, that weak balance sheet basket is still down more than 10%, John.
Sarah, the story's not over yet. Sarah Ponczek on the bankruptcies and the weakness in some of those weak balance sheets at the moment. BlackRock's Jim Keenan seeing opportunities in distressed debt, writing the following: investors seeking total return are shifting money back towards private markets, anticipating deal flow and distressed opportunities to pick up over the next year. Jim joins us now with more. Jim, always great to touch base with you, sir. I just want to draw the distinction between the liquidity issues that we were facing back in spring and the solvency issues that we continue to face now. Can you talk to that, Jim?
Sure. No, absolutely. I mean, obviously, the spring was an extraordinary environment where you had really kind of a market liquidity shock, and you saw the huge dislocation as the markets and the world faced the uncertainty with regards to the virus, but also policy in the response to that. As you've seen significant fiscal and monetary policy, as well as an understanding and progressions around treatments and vaccines and testings, you've seen this V-shape off of the bottom. But that being said, there's still an earnings dislocation, and I think that's what you're seeing now. The dispersion between the impact of the virus and what that means for behavioral change, what that means for policy, has a very different impact on certain industries that are very, we call it more contact heavy, lodging, leisure, transportation, things like that. Versus this work from home, stay at home, and some of the trends that you've seen that have been very positive in the technology space. So very different, but I would say V-shape off the bottom, but the next couple of years is going to be a grind for some of these sectors to try to get back to more of a normalized level of earnings and economic activity.
Jim, from my perspective, given that I'm not in your seat right now, I could say the easy thing to do would be to say, pick this sector, avoid this sector. Within industries, within the impacted industries, the ones that are suffering, are you finding opportunity still, Jim?
Absolutely. I mean, and I think you just touched on it with regards to the beginning of the year, or for the last 6 months, the strong balance sheets have really recovered really well, right? And as money came back into the market and liquidity came back to the market, there was a lot of opportunities, and you've seen whether it's the equity markets or the spread markets really recapture really the large majority of the dislocation that we saw in spreads in the March-April environment. I think when you look at it now, there are certainly these industries and these names that are impacted by the virus, and that will result in some form of restructuring, whether through a bankruptcy process or an out-of-court process where a company is going to either rationalize or restructure its balance sheet because they need to get that debt level to a more normalized level to today's operating earnings. And I would say what we see, just because of the breadth of the virus, right, and just the impact that it's had across and the severity of 2020, but the duration that it has on kind of some of these industries over the next couple of years being below the 2019 levels, there are some really good businesses that didn't necessarily have the best balance sheets coming into this type of environment. And there are opportunities there. And there are opportunities similar to what we saw post the 2008-2009 environment, where good companies just need to restructure, but will be well positioned as those industries normalize over the next several years.
So, Jim, I know there's some distressed investors, not you, were upset about how quickly spreads closed and the Fed's participation in the market because the opportunities went away pretty quickly. You're saying they still exist. Can you add a little bit more color into how you find them at the moment?
Yeah, I don't know. Be upset about the recovery of the market, and I think our policymakers did a very good job about providing liquidity and trying to aid the markets to have a more normalized environment, and I think that's been a success. That being said, some of these industries, just because of the dynamic or the reality of the virus in itself and the impact, it's creating behavioral change, it's creating volatility around policy, and we are seeing second waves in certain states or certain countries across Europe. And there will be volatility over the next couple of years until you see a true vaccine and a more normalization with regards to the mortality rate curve. But there are definitely still opportunities. I would say the March and April environment was a pure dislocation. There was a wide breadth of opportunities that was only successful because of the policy response. Today, it's harder, but you have to look at good and find good companies. And I do think, when you look over the next couple of years, some of these companies, as they start to normalize through the credit, if you can invest kind of at these trough earnings or trough multiples, not necessarily the lows of March and April when everything was priced as liquidation, but when you look at it today, some of these businesses, and you think about their normalization to their growth trends and their value proposition, there are some good opportunities out there through the credit markets from a distress perspective.
Jim, always great to touch base. My best to you and a team over at BlackRock. Jim Keenan there on this market. This equity market up 0.4%, 22 minutes in on a sector price action. Here's Abigail.
John, we are looking at a modestly risk-on sector composition at this point, in line with the S&P 500's modest gain. If we use the IMAP and the Bloomberg terminal, you will see all 11 sectors are higher, so investors want in on stocks. We also have most of them up by about 0.4% or more. Energy up top, up 1.7% on possible takeover talk of Concho Resources. Industrials next on airline strength. And then that stay-at-home trade right behind it with tech and communication services. But overall, the bulls are out today, John.
Abigail, thank you. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From London and New York, this is Bloomberg.
has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
In, equities positive, up 0.4 on the S&P, up 0.5% on the Nasdaq. Here's your trading diary. Happening right now. It's day 3 of Supreme Court nominee Amy Coney Barrett's Senate confirmation hearing. You can watch it live on Bloomberg Live at LiveGo. President Donald Trump speaking from the Rose Garden at 11 Eastern before holding a campaign rally at 7 this evening in Iowa. Fed President Robert Kaplan hosting a virtual town hall at 6 o'clock this evening. Morgan Stanley reporting results on Thursday morning. Plus, we'll get another round of initial jobless claims. And finally, on Friday, we get U.S. retail sales to close out the week. From London and New York, that's it for us. We'll close out the show. This was the Countdown to the Open. Catch me on Twitter at FeroTV. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has coming here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.